Hello all of you, I hope you are doing good. Today we are going to do the revision of very important topic, that is consolidated financial statement. In examination, 100% one question is going to come on this topic, that is consolidated financial statement for 14 marks. So generally people find it very difficult topic, but let me tell you honestly, this is not a difficult topic at all. I will tell you the first concept, each and every concept I will discuss with you that. And I will tell you certain steps that you have to follow to solve the question. Easily, you will be able to solve the question. And here you can see that in this rapid GIS book. Here there are certain steps are mentioned. I will tell you that in each and every step that here it's working note, notes to account, all these steps that you have to follow that. Okay, so what we will do that here now. I will tell you the concept. Okay, first I will tell you concept, just you have to listen me carefully. Then after that, obviously we are to cover the super 50 question. From the super 50 question, we'll cover today the consolidated financial statement chapters questions. Okay, so just listen me carefully. I'm going to cover each and every concept here. Okay, so don't worry, it is not a difficult topic at all. Very simple. Basically, this consolidated financial statement covers by accounting standard 21. Okay, so now let's start. Okay, listen carefully. Let me write it down here. Consolidated financial statement. What happened in every question? Yes, in every question when you solve it, there are certain things. If you're able to do those things that here in advance, that here, it will be so easy for you. Okay, it will be so easy for you to solve the question. There are certain steps that you have to follow those steps that here. Okay. And if you analyze something that I will tell you that here, how to find it out. If you're able to do that, easily you will be able to solve the complete question. And this question is going to come an examination for 14 marks. Okay. So let's start one by one. So write down there. Okay. First, suppose if I say that now, okay, it's better if you write it down. Okay. Not so much, but mostly I will cover from the rapid GIS only, but I want to create a background first. Okay. Even though it's a marathon. Okay. Now understand that. If I say this is a holding company, this is a company, let's say the A Limited that. There is a company, A Limited that. Obviously, at the end of the financial year, everyone wants to see the performance of the company. So they prepare their standalone financial statement. What do we mean by standalone financial statement? They will prepare their profit and loss account, balance sheet, cash flow by the holding company. Or you can say the A Limited that. Now this A Limited actually hold more than 50%. Then if they have a control on some other company, so basically if you have a control on some other company, we call them that is a subsidiary company. So suppose it holds more than 50%. Okay, so there is one more company and let me call it a subsidiary company. Okay, let me write it down here. Subsidiary company. So subsidiary company, let's say B Limited that here now. Subsidiary company B Limited. Now what happened is that both of them is going to prepare their financial statement at the end of their individual that is. So here, holding company will prepare their financial statement that you know, they will prepare their profit and loss account, balance sheet, okay, individually. So they will prepare their individual financial statement. Okay, individual financial statement they will prepare. And similarly, subsidiary company will also prepare their individual financial statement. So both of them will prepare their financial statement. But as a group, how we are doing, which is important that here, because if one company controls another company, so how as a group we are performing, that we want to calculate, that we want to basically know. So what happened that at the end of there, in addition to this individual financial statement, what is going to happen that here? The holding company is going to prepare one more financial statement. What I'm saying that here, in addition to individual financial statement that here now, both of them have prepared their individual standalone financial statement, we also call them. So at the end of the year, in addition to these standalone financial statement, holding company is going to prepare one more financial statement, and what we call them consolidated financial statement. So when I say consolidated financial statement, it means they are merging two financial statements of holding company and subsidiary company. So I want to know that here now as a group. Okay, I want to know that here as a group how they are performing here. So this is a group that here. Okay, I want to know that here now how as a group they are performing here. Okay, how as a group they are performing here. We know that both of them are preparing their individual financial statement. But as a group, how they are performing, that we want to know, and what we call them, we call them consolidated financial statement. Who is going to prepare this consolidated financial statement? By the holding company. So holding company is going to prepare the consolidated financial statement. Okay. So this is the group this is a group. Okay, this is a group. So we call them group companies also. So group companies. Okay, group companies here, A limited and B limited. So what will happen here now? Holding company will prepare what? Consolidated financial statement. Consolidated financial statement. You got the point that here now? Who is going to prepare the consolidated financial statement? The holding company is going to prepare consolidated financial statement. What is consolidated financial statement? As a group, basically we are merging two financial statements. It looks very simple to merge the P&L balance sheet, but there are so many adjustments that we have to do. Each and every adjustment in these marathon I'm going to discuss with you. Don't worry for that. Okay. But when I say that here now, suppose this is the financial statement we have. Okay, these are the two financial statements that we have. Okay, now understand how basically what is the process for that. So I have one financial statement that here now. This is one financial statement that I have. Okay. This financial statement suppose of the holding company. Just give me a minute. Okay, this is the financial statement of holding company. Okay, let me write it down here. Holding company. Holding company. I'm just talking about the balance sheet first. So P&L I will discuss later on. This asset side, to make it simple, I'm writing like that. The liability. Here I have property, plant and equipment of holding company, property, plant and equipment. Now they have certain investment, okay, investment in subsidiary company. Is it visible? Yes, investment in subsidiary company. I have here current asset. Okay. Now I have here share capital. Then we have here reserve and surplus. Okay, we have reserve and surplus. Non-current liability we have here, non-current liability. And we have current liability here. Okay. So basically it's a balance sheet of a holding company. Okay. Now what we want to do, we want to merge two balance sheets because we are preparing what? Consolidated financial statement that here. Okay. Now I have here, now this is a balance sheet of subsidiary company. This is a balance sheet of what? A subsidiary company. So if I write it down that here now, this is a liability. Liability, asset. So this subsidiary company balance sheet. Okay, subsidiary company balance sheet that is. Okay. Now they have their property. Okay, they have their property, plant and equipment, suppose here. Okay, they have their current asset here. They have their share capital. Now reserve and surplus. Then we have your non-current liability. Then I will say that here the current liability. Okay. Now what happens is that here when we talk about this financial statement that here. Okay. So these are the two separate financial statement. We want to consolidate these balance sheets. So when I say we want to consolidate these balance sheet that here now, what is going to happen now? We will add, you will say simple sir, just add the figures like PP, investment, current, add it. Okay. Now understand this point. I agree with you that when we prepare a consolidated balance sheet, we just have to merge it, but understand the logic here. I say who holds the shares in a subsidiary company? Holding company. Suppose A Limited is a holding company. Who holds the shares in a subsidiary company? It means that, what is the main area I'm discussing with you? Okay, it means that the share capital of subsidiary company and reserve and surplus of subsidiary company. Here in these share capital, something is held by a holding company. Do you agree or not? That is a share capital. Suppose your holding company hold 80%. Let me write it down that here now. Suppose if I say that now 80%. Okay, if I say that here now 80% that now, just give me a minute. Okay. If I say that now, suppose a holding company, we hold here how much here? 80% and 20% is held by someone else. That is. Now understand this point. So what is going to happen now? We call them this 20% hold in a subsidiary company. We call them minority interest. What we call them? We call them minority interest. So accounting standard 21 says them minority interest that here. Okay. Now, when I say that here we are holding company, we hold 80% shares in a subsidiary company and 20% hold by someone else that here. We call them minority interest that here. But what happened is that now, when I say that here about the subsidiary company in their share capital, we are not the 100%. We might be 100% shareholder. So, but in our example, we hold 80% shares. So here in these share capital that here, we holding company holds how much? 80%. In our example, how much we hold? 80% that here. Okay. Now, and 20% hold by someone else. And we call them minority interest. So, if I say that here now, here in this, okay, let me write it down here. We hold, suppose that here now, 80%. Suppose. Holding company hold 80% and minority hold how much here? 20%. It means these share capital, 80% belongs to holding company because we all are holding companies because we hold only 80%. And 20% belongs to a minority interest. What is the minority interest? In subsidiary company, shares hold by someone else. We hold 80%, whatever remaining, we call them minority interest. Okay. Now, in these reserve and surplus, it means that here in these reserve and surplus also that now, we hold how much we hold that here now? We in reserve and surplus also, I will say that here, pre and post. You will say, what is this pre and post? There are certain terms you have to be familiar with it. What is pre and post? Pre means that what is the profit of subsidiary company? What is the profit of the subsidiary company before we hold the control on them? We purchase, for example, we purchase 80% shares on 1st of January 2025. So whatever profit that they have till the 1st of January 2025, that is the pre-acquisition profit. And whatever profit made by a subsidiary company after 1st of January 2025, we call them post-acquisition profit. To make it simple, that is the profit which is made by subsidiary company before we hold a control on them. We call them pre. And whatever after that, we call them post. So you will tell me this, sir, why there is a need for this bifurcation of a reserve and surplus of subsidiary company in pre and post that year? The reason is that we have to do the bifurcation between the pre and post that year now. The reason is that treatment is different. I will tell you what is the treatment, but we have to. This is the one of the biggest challenge you have when you solve the question of consolidated financial statement. One of the biggest challenge you have to bifurcate the profit of a subsidiary company between pre and post. How to do that? I will tell you that. But we need the profit of the subsidiary company between the pre and the post, that you have to understand this. Okay. So what I will do that when I say that pre. So in case of a pre-acquisition profit that here, some profit belongs to the holding company and some profit belongs to the minority. That obviously, if we hold only 80%, so that profit of the subsidiary company, if we hold 100% shares of the subsidiary company, means we are the owner of the subsidiary company. Whatever profit that is, that belongs to me. Correct? Me means holding company. But if we hold 80% only, so 80% belongs to us and 20% belongs to minority interest that year. So pre-acquisition profit, holding company to holding company, it belongs how much? 80%. In our example, to minority interest is belong 20%. Same post-acquisition profit, 80% belongs to holding company and 20% belongs to the minority interest that year. So what is important is here when we talk about it that here now, is the share capital and subsidiary, share capital reserve and surplus of subsidiary company is need to be bifurcated, how much it belongs to the holding company and how much reserve and surplus of subsidiary company belongs to holding company and the minority interest that here. So you will tell me, sir, why did the need for it? Let me tell you one by one. First, let's talk about only the minority interest that here. Because when we prepare consolidated balance sheet, what I said, when we prepare consolidated balance sheet, what is going to happen that now? It's easy to merge the asset, liability, everything I will just merge. Okay, we'll combine it, we'll write it down in consolidated balance sheet. But some portion of the share capital reserve and surplus hold by someone else, we call them minority interest that here. So in my consolidated balance sheet, one section is going to come for the minority interest. But when we talk about asset and liability, we'll merge it 100% only. We will not tell that we hold only 80% in subsidiary companies. So I will take only 80% of asset, 80% of liability. No. Asset and liability, AS21 says asset and liability should be merged 100%. So if I say my PP is 10 lakh, subsidiary PP is 20 lakh, I will merge it, I will take say 30 lakhs. So where I have to do the bifurcation in the share capital reserve and surplus of subsidiary company. I am saying share capital reserve and surplus subsidiary company. Here in that share capital reserve and surplus subsidiary company, something belongs to me, we are holding company, and some belongs to a outsider, we call them minority interest. We hold 80%, so 80% belongs to us. 20% hold by minority, so 20% belongs to the minority interest. So we need a bifurcation. Why? First, let me talk about the minority interest point of view. Because when I prepare the consolidated balance sheet, there's a one column will come on liability side and we call the minority interest that here. That minority interest represent that here. How much share capital of subsidiary company, how much profit, reserve and surplus of subsidiary company belongs to the minority interest. Now you will ask me, sir, you're talking about how much share capital, reserve and surplus of subsidiary company belongs to minority interest. But some portion of share capital and reserve and surplus of subsidiary company belongs to the holding company as well. Correct. I will discuss with you. That portion. First, I am talking about the minority interest that here. Now what happened? One by one. Very important point I'm discussing with you. Now let's talk about first is the reserve and surplus. Okay, let's first talk about, let me write it down here, reserve and surplus of subsidiary company. I'm saying reserve and surplus of what here? Subsidiary company. Okay, the two things that I want to discuss with you, which is very important. Reserve and surplus of subsidiary company and share capital of subsidiary company one by one. But reserve and surplus, basically, we bifurcate into two parts. Okay, the reserve and surplus of subsidiary company, we have to bifurcate. Suppose if I say, now this is the date of acquisition. Date of acquisition, the date you acquire the control in subsidiary company. This is the date of acquisition. So whatever profit that they have before the acquisition, we call them pre-acquisition. What we call them? We call them pre-acquisition profit. So I say this is pre-acquisition profit. What I call it? Pre-acquisition profit. Okay. And pre-acquisition profit, we are talking about subsidiary company. Okay? We are discussing about the reserve and surplus of what? Subsidiary company. I am not talking anything about a holding company reserve and surplus. Subsidiary company. Okay. Now the profit that they have made after the date of acquisition, we call them post-acquisition profit. Okay, we are talking the post-acquisition profit of, if you want, just give me a minute. If you want, I can write it down here in bracket. Post-acquisition profit of subsidiary company. Okay. Now understand, pre-acquisition profit, the profit which is made by the subsidiary company before we acquire a control on them. Okay. Now suppose if I say in a pre-acquisition profit, some profit belongs to the means a holding company, because we hold 20%. Minority company or minority interest hold 20%, 80% hold by us. Let me write here the 20%. Let's first talk about the minority, and 80% belongs to the holding company. Okay. Now same here is going to happen in post-acquisition profit. Okay, in post-acquisition profit here, 20% belongs to the minority that here, and 80% belongs to the holding company. Okay, now understand this point here. So for here, if I say this 20% belongs to a minority interest, so let me write it down here, minority interest. This profit belongs to the minority interest. This profit also belongs to minority interest. So what is going to happen? Whatever profit made by a subsidiary company that here, first the portion which belongs to the minority, we have to give it to them. You know what is the biggest challenge you have in consolidated balance sheet question? To bifurcate the profit of subsidiary company between pre and post. That is, if you have done that, you 50%, it means chances, the 50% work you already have done it that year. If you're able to bifurcate the pre and post acquisition profit in rapid, just very beautiful, it is mentioned that here. I made a note stock on all that. I will tell you how to prepare all this working note. Okay. Now what happened? So some portion belongs to the minority interest. That it means that here, if I say that, okay, just give me a minute. If I say that here, these portion of the pre-acquisition profit, these portion is of the minority interest, correct? Pre-acquisition profit and these portion belongs to the minority interest. That is. So if I say that now, okay, let me highlight this point here. Okay. So these belong to minority interest. These also belongs to what here? The minority interest that here. These also belongs to what? Minority interest that here. Okay. Now understand that here. I have not yet come the portion that belongs to the holding company in the reserve and surplus of a subsidiary company. Now, one more thing is that here now we are discussing about the share capital. I am saying share capital of subsidiary company. I am saying share capital of what? Subsidiary company. Again, here in case of a share capital, we don't bifurcate between pre and post. Only the profit we have to bifurcate. Why we do that? I will tell you that here. But here, the share capital also is going to be bifurcate between the minority and the holding company. Suppose 20% belong to same, obviously it belong to the minority that here. So it belongs to the minority interest that here. Okay. So what is going to happen when I prepare consolidated balance sheet? Okay. When I prepare consolidated balance sheet. So in the share capital reserve and surplus of a subsidiary company that here, that we are not going to write it down as a share capital. These three, the point that I've highlighted here, okay, these three belongs to the minority interest that here. When I prepare the consolidated balance sheet that here, in a share capital reserve and surplus, first I'm just talking about the minority. Okay, I will come to the portion that belongs to holding, don't worry. But here in these share capital and reserve and surplus, the portion which belongs to the minority, we are going to write it down as a minority interest in consolidated balance sheet that here. So what I will do that here now? What I will do that now here, I will write it down these minority interest will be one heading. We will not write it down the share capital with the name of share capital reserve and surplus in consolidated balance sheet of subsidiary company. I'm going to, holding company is going to prepare consolidated balance sheet. In that there is no share capital reserve and surplus of subsidiary companies heading that here. These two figures we are not going to write it down directly in consolidated balance sheet that here. So how are we going to write it down these figure here in this reserve and surplus? First I am talking for the minority interest only. Okay. In these reserve and surplus that here now, the portion which belongs between pre and post and which belongs to the holding company, which belongs to the minority, and the share capital which belongs to the minority. In these reserve and surplus, the portion which belongs to minority, in these share capital, the portion which belongs to minority, I will make it separate heading and I will write it down minority interest. In that, I will write it down all these things: pre-acquisition profit of minority, post-acquisition profit of minority, and pre-acquisition, the share capital that belongs to the minority in subsidiary company. So what we'll do that here now, here in these share capital reserve and surplus, the portion which belongs to minority will make a separate working note on that here, and that working note will write it down in the share capital here which belongs to the minority and the reserve and surplus which belongs to the minority. So this separate heading. We are not going to write it down directly the share capital as reserve and surplus subsidiary company in consolidated balance sheet. Okay, be careful that here. So in the consolidated balance sheet, I will take the portion of the minority interest in share capital reserve and surplus. I will make a separate working note. I will write it down the amount, and that amount will appear in balance sheet as a minority interest. Now next question. You will tell me, sir, but there is one more issue that here now. Here in these share capital reserve and surplus, some portion belongs to the holding company as well, because if minority hold 20%, we holding company hold how much capital? We hold 80%. So 80% belongs to whom? To the holding company, correct? So that same also, we are not going to write it down this share capital reserve and surplus directly of subsidiary company. The portion which belongs to minority, will write it down as a minority. But the portion that belongs to holding, how to write it down? The portion here, this capital reserve and surplus, how to show it, that the portion that belongs to holding company, the share capital reserve and surplus subsidiary company, how to present them? Understand this point. First, we have to bifurcate the profit between the pre and the post acquisition. Okay. Now here, what is going to happen? Let me write it down here now. Just give me a minute. Okay. Now what happened now? I will tell you the logic why accounting standard 21 says you that. I will tell you the logic also. Okay. I will tell you the logic that here now. First two things I am talking about. On the date of acquisition that here, okay. On the date of what? Here, acquisition that here, okay. Just give me. Okay. On the date of acquisition that here, okay. On the date of acquisition that here, obviously, we paid something to acquire 80% shares. Do you agree that here? We paid something to acquire what? 80% shares in subsidiary company, correct? So in return, what we are getting, post-acquisition profit was not existed on the date of acquisition that year, because that is the profit made by subsidiary company after we hold a control on them. The profit which is made by the holding company, the subsidiary company on the till the date of acquisition. Okay, so let's take an example that now these one more thing I'm highlighting here that is not going to appear in consolidated balance sheet. Now understand the two things that which I'm highlighting here. Suppose if I say that here now, on the date we acquire these the point that I've highlighted, the amount that we have invested in a subsidiary company, it will also not appear in consolidated balance sheet. The three things that I've highlighted here, it is not going to appear directly in consolidated balance sheet. Let me tell you the logic also. Okay. So suppose that on the date of acquisition, I paid, let's say that here, 1 lakh. I paid 1 lakh to subsidiary company because I want, suppose we acquire 80%. But in return, what I hold that here. So here 80%, okay, here if I say 80%, this 80% that here now is belongs to me, correct? So on the date of acquisition, they are giving the 80% share capital and the 20%, this 80% profit there, this 80% profit. This profit was not existed, post acquisition profit was not existed on the date we acquired the shares in subsidiary company, correct? So when I have done the investment that year, I have done the investment by paying how much here? I have done the investment by paying how much? 100,000 that year or 1 lakh. Okay, what they are giving me in return that year? They are giving me suppose share capital. So it means that here, this share capital, they have share capital. They have suppose the share capital is coming 80%, any amount I'm writing, suppose 80,000 that year. Okay, and here pre-acquisition profits is coming how much? Let's say the 15,000 hypothetically. Okay. So the amount that I have done the investment in a subsidiary company, I paid 1 lakh. In return, the share capital subsidiary company belongs to me 80,000, and the profit that which existed on the date of acquisition, the portion that belongs to me, that is 15,000. So I gave them 1 lakh. In return, they are giving me how much here? 80 and 15,000. So I paid something more to them. 1 lakh I paid to them. In return, I am getting 80 minus 15. So something I'm getting the value of how much here? 95. How much we are paying to them? I am paying to them 1 lakh. In return, they are giving me something, the value of that how much here? 95. So I paid additional 5. I will come to that here. But remember that now, these 2 points that I've highlighted here, that is, we know about whatever belongs to in these share capital, reserve and surplus, whatever belongs to minority, that will go in a minority. It doesn't matter pre and post that here. But when it's come to the holding company, the portion that belongs to holding company, how to present that here? Because when we prepare consolidated balance sheet, we are going to merge it. How can you say that the amount that invested, which is appearing on asset side and which is invested and the share capital, reserve and surplus will appear on liability side, because we're merging it that here. Okay. So it should not be like intercompany transaction. So this investment should be cancelled and the portion that belongs to us here should be cancelled here. Because this is the amount that we invested in subsidiary company. Okay. This is the amount that we have what invested in a subsidiary company, correct? This is the amount that we just give a minute. Okay, this is the amount that we have invested in a subsidiary company. Now, what is going to happen now? If this is the amount that I've invested in a subsidiary company, and in return, what they're giving to me? Suppose I invested here 100, let's say the 1 lakh rupees I have invested here, and in return that in share capital 80,000 belongs to me, and the profit which is existed on that 15,000 belongs to me. So we invested 1 lakh. In return, the value that we get on that date 80 plus 15, suppose that is coming 95 that year. So what is the difference of what is the treatment of that 5,000? I will discuss with you. But what is going to happen? These the figure that I've highlighted here, these with the pink color, it is not going to appear in balance sheet that day. So what is going to happen? They say only the difference, write it down. This 1 lakh we have invested and this 1 lakh minus 80 minus 15. So how much we'll get remaining is 5,000. So that we call additional amount that we have paid. So we call them goodwill. So basically this cost of investment basis from this pre-acquisition profit. What we do that, let me write it down that here. Deduct from cost of investment. Deduct from cost of investment that here. Okay. Now here 80% when I say that here now, this deduct from cost of investment. So remember that here better, these two things is going to be deducted from the cost of investment. So if I say that now, these investment in subsidiary company and the portion in share capital, reserve and surplus, reserve pre-acquisition I'm talking about, This is not going to appear in balance sheet. The net effect will appear. So net effect is how we'll show is 5,000. I will tell you. If I pay the additional amount, so age 21 tell us that treated as what? The goodwill. It will appear as goodwill. So it might be happen negative figure may also come that I will discuss with you. We call them capital reserve that here. I will come to that. I don't want to make it complicated initially. I will come to that point here. Okay. But one more thing is which is not yet covered. Which one? This is the post-acquisition profit. So these profit basically was not existed. These profit basically was not existed on these profit. This whatever belongs to minority that we know that. But these profit, this 80, I'm talking about this now. It was not existed on the date of what? Acquisition. So it's a revenue nature profit. So how we have to do? What should be the treatment of these? Add. Write it down that add. To basically all this is given in rapidly, still I am writing that add to profit of what? Holding company. It's a revenue nature profit. That it's a revenue nature profit. So these will appear. What will happen now? These will appear that, okay, just keep it. Okay, these will appear that here in the reserve. They will add it that here. So holding company will add these portion of post acquisition profit in their what they will do that in their profit. Okay. So because it's a revenue nature profit that is. So if you get the mastery in this treatment, you've done it the consolidate. I'm telling you, this is the toughest part of this topic that is. Now let me repeat it. Let me simplify for that. When we want to start solving a question on it that here, remember this figure is not going to appear in consolidated balance sheet directly. Now first let's share capital reserve. First part is simple that now. Whatever portion belongs to subsidiary, this minority in share capital reserve and surplus. So we'll make a one working note on that. We'll write it on the pre-acquisition profit belongs to minority, post-acquisition profit belongs to minority, and share capital belongs to minority. Very simple. Then these share capital that here. Now I'm coming to the second part. Whatever belongs to the holding company, the investment done by the holding company. Okay, that will not appear in consolidated balance sheet. We'll write it down. We'll deduct from it that here. The portion which belongs to the holding company in this share capital, and here these profit have to be bifurcated between the pre and post, and the profit belongs to holding company in the pre-acquisition profit. So these two has to be deducted from the cost of acquisition. Difference if positive, AS 21 tells treated we have paid the additional amount. Obviously we paid the additional amount, so they tell us to treat it as a goodwill. That if it is coming negative, we call them capital reserve. Why we call them, I will discuss with you later on. Okay, now. But now, what about the post-acquisition profit which belongs to the holding company, subsidiary company, reserve and surplus? This is the revenue nature profit. So it should, because this profit was not existed on the date when the holding company controlled the subsidiary company. Okay, when they invested in subsidiary company, these profit of post-acquisition basically is going to add to the profit of the holding company. Now, what is going to happen now? If you get the art of bifurcating the profit between the pre and the post, this is the main part. Otherwise, very simple topic, very simple. So to make it simple, what I have done that, I will tell you the steps, proper steps that what should be the working note number, what should be the notes of number 1, 2, 3, 4. I will tell you exactly like that you're going to prepare in your examination. I will tell you what should be the working note number 1 should always be in shareholding pattern. Working number 2, analysis of profit of subsidiary company. 3rd, calculation of goodwill or capital reserve. 4th, etc. I will tell you each and every step that here. Okay, you just have to follow this step that here. Once you follow this step, I'm telling you that here 100% you're going to score 14 out of 14, not even 40, 13 out of 14. Just you have to listen me carefully, follow the instruction that here, and you are going to easily will be able to solve this question that here. Okay, now. This is the main part. Okay, when I will solve the question that you will discuss the question, this is going to come. Now, what happened that now the student face the challenge with due respect to ICI, but when you see the ICI study material, with due respect to them that year, okay, you will get confused there, and from where the figures is coming and all that. This chapter is all about the numbers calculation that year, and there are so many numbers is going to come pre, post, okay, minority and all that. So beautifully, what we'll do that here in every question we have to prepare this this working number 2, which analyze the profit of the subsidiary company. And I know that what is going to come in pre, what is post, exactly like that is mentioned. So let me tell you that here, what should be the strategy, what should be the step you should have to follow when you prepare a consolidated balance sheet. I will come to the point of consolidated profit and loss account. I will discuss with you there. Okay. Now, what happened in case of a consolidated balance sheet that now I will tell you this step, just you have to follow these steps Exactly like that, you have to prepare the notes to account, working note. You will get 14 out of 14 in exemption. I'm telling you that. Just listen me carefully. Now let's start with the format. I'm not discussing with you all these stuff. Now I already told you that what do you mean by holding company, minority, and all that. Okay. The main part is that here, which is given in rapid, just page number 45. That here. Okay. Now when we prepare consolidated balance sheet, the format should be like it. You say no, sir. When we prepare a financial statement of company, it was in much detail. No, listen to it. Where their purpose was to test you the format of the financial statement, adjustment, and all that. No. Here is simple. Equity and liabilities, shareholders fund, equity share capital, reserve and surplus. You are going to prepare one note to account that on these. Exactly. Okay. Now one more point will come: minority interest, non-current liability, current liability. This is a new point for you, minority interest. Asset, non-current asset, PP, intangible, non-current investment, current asset. These four notes to account is fixed in each and every question mandatorily. You have to prepare these four notes to account. How to prepare that? I will come to that. Okay. I will go to the connection that they have between all these working note and notes to account that here. Because there are four notes to account also you have to mandatorily in each and every question you have to prepare. Now four notes to account you have to prepare. In addition to that, if you want, you can add more notes to account that here. So what is the first notes to account? That is share capital. Now please listen carefully. Okay. So they say if authorized share capital mentioned, it will come here. Issue, subscribe, and pay. But these share capital we are talking about, whether here in these share capital, whether the share capital subsidiary is coming, no. Why? I told you that. No, these two figures is not going to come directly in consolidated balance sheet. It is not coming there. Okay, it will come in the form of minority interest, or it will be deducted from here, or it will be added to the profit of the subsidiary company, whatever the treatment that here, but they are not going to come directly like a share capital, reserve and surplus of subsidiary company in consolidated balance sheet. So here these figure basically is the share capital of holding company only. Now reserve and surplus, different types of reserve and surplus. We have general reserve, capital reserve. So what is this profit and loss? I will tell you that here. What is the working number 4? Don't worry for that. Okay. Now, whether here in reserve and surplus, whether the reserve and surplus of subsidiary company is coming here, no, the reserve and surplus of subsidiary company is not coming. I told you that here now. This reserve and surplus is not coming there, beta. That will be come in the form of, that will go in the form of minority interest, or that will be deducted from the cost of investment, and that will be added to the profit of the holding company. But they are not directly coming in reserve and surplus in reserve and surplus when we prepare the consolidated balance sheet. Okay. Now, what is going to happen? Now, the third working note is what? Not working note. Notes to account is what? Minority interest are here. So, what is going to happen here in minority interest? We have to write it down. The share capital. I told you that here about these share capital. You can see that this share capital, correct? This share capital. Okay. What will come there now? Pre-acquisition profit, post-acquisition. Don't worry about this working note. I will tell you that here. Okay. So you can see that here, pre-acquisition profit in the post. This green color, basically there is one notes to account in that, and we call them minority interest that here now. Now it is important because the main task here in these chapter challenge is to analyze the profit of subsidiary company. How to do that? I will tell you. Don't worry for that. You are very talented. Trust me, just you have to listen me carefully. You are going to score full mark in this consolidated financial statement. Now, so here in I will write it down. These portions belong to minority interest. You can see that here, this green color, basically, this is going to appear there. Okay. Now, 4 notes to account. If you want PP, also, very simple PP. These 4 are mandatory. Apart from these 4, if you want, you can make it. There is no restriction there. Okay. Now I am coming to a notes to account here in these notes. I'm coming here not notes to account, working note. You have to prepare these 4 working note. You have to prepare mandatory. In the way I am telling you that exactly like that you are going to prepare here. Okay. Now first your working note will be on. The first is shareholding pattern. You know why it is important, this shareholding pattern? The first working note should always be on shareholding pattern. Why? Because obviously we have to do the bifurcation of the profit, the pre-acquisition, post-acquisition, then the profit total come, how much belongs to the minority, how much belongs to the holding company. Okay. So first, always we have to make a working note that here, how much belongs to the holding company or parent company and how much belongs to the minority. Percentage you have to write it down. Second working note will always be on analysis of profit of subsidiary company. This is what I'm talking about. Analysis of profit of this subsidiary company. So whatever is the profit of the subsidiary company, we have to analyze between what? The pre and post. Why we have to analyze between the pre and post that here now? Because they're different treatment. When first don't bifurcate between the minority and that. First you have to bifurcate pre and post. In a pre and post, what is generalism P&L, I will tell you. But profit of the subsidiary company is going to bifurcate between how much belongs to pre-acquisition, how much is the post-acquisition. All these adjustment that I know that what kind of adjustment generally comes in pre and what kind of adjustment generally comes in post. So this is the treatment given here for the pre and the post acquisition profit is presented in a manner that generally possesses question. However, a student have to be careful while reading the question and deciding on the treatment of the pre and the post acquisition profit based on the information given in the question that here. Okay. So these are the generally it's come in the pre and post. That's why I have written there. Now, what happened here now? Now in the mind, the once you find it the pre and the post that here, we are going to bifurcate that here how much belongs to a holding company, let's say 80%, and how much belongs to subsidiary company 20%. So bifurcate the pre and the post acquisition profit between the holding and subsidiary. Whatever belong to the subsidiary company that, okay, whatever belong to subsidiary, minority that here, I will write it down in the minority. And there's a notes to account number 3. Notes to account number 3 will always, you can see that here. Notes to account number 3 is on minority, always that here. So these portion which is coming pre and the post acquisition profit, whatever belongs to the minority that here, that will come in the minority interest column. But whatever belongs to the holding company that here now, you know that here now, what is the treatment of these profit that here? It should be deducted from the cost of investment that here. So you can see that here now, these profit of the pre-acquisition that which belongs to the holding that is working note number 3. So this working number 3 is basically calculation of goodwill or capital reserve. This is the cost of investment. Don't worry about what is this dividend out of pre-acquisition profit. I will discuss with you later on. This is the cost of investment. I will deduct two things from that. What? That is the pre-acquisition profit which belongs to the holding company. So this pre-acquisition profit which belongs to the holding company, go to working number 3. This is working number 3 that here. So where it's come? It's come from working number 2. Everything is reference is given there. Perfect. Okay. Now here, what about these? What we will do that for the post-acquisition profit, these which belongs to the holding company will add to the profit of the holding company. So it will go, this is the post-acquisition profit. Okay, basically if it is related to general reserve, it will go to the general reserve. If it is related to the profit, it will go to the normal P&L account of the holding company. Okay, so what will happen now? This basically is that a post-acquisition profit of subsidiary company which belongs to the holding company that will add to the profit of the holding company. If it is general reserve, add to the general reserve. If it is P&L, add to the P&L like that. Okay, don't get confused that here now. We are working on number 4 is on the profit and loss account of the holding company. But you will say, but sir, the P&L balance of the holding company should come under reserve and surplus. I agree with you. The profit and loss account balance of holding company should come under reserve and surplus. But there are certain adjustment of it. So what we do that we make a working on number 4 on that adjusted P&L account of holding company. We write it down whatever balance is given in the balance sheet. And whatever adjustment is given, we do the adjustment here, and which comes to, to the adjustment which is related to this profit. We do the adjustment, and the adjusted figure whatever come, then that we transfer to reserve and surplus. That's come from the working number 4. Let me summarize for you in a simple form. First, you'll draw a balance sheet. How many notes to account? 4. Share capital, reserve and surplus, minority, and PP. Then here is the how many working note? 4. First, shareholding pattern. Then analysis of profit of subsidiary company. Don't worry about this adjustment. I will discuss with you. Okay. Analysis of profit of subsidiary company. Third, calculation of goodwill or capital reserve. So here, what is going to happen now? The capital also, I told you that this capital, whatever belongs to minority, it will go to minority. Whatever belongs to the holding company, that will deduct from the cost of investment. So here, whatever belongs to minority, it will go in minority here. Whatever belongs to the holding that here, that will deduct from the cost of investment. If these figure comes here positive, we call them what here? The goodwill. If that is negative, we call them capital reserve. There's a logic behind. If you paid additional amount that here, suppose we have done the investment of 1 lakh, but basically capital, whatever we suppose, let me write it down that here. Okay, so suppose I paid 1 lakh here. Okay, and here it is coming 95. So I paid the additional amount. So they say write that 5 as the goodwill that here now. If I say I paid 100 that year, but this is coming, let's say 110. So I paid here 100, but in return I am getting more. So it's a benefit for the holding company. So that negative figure is, that's why they call it as what? Capital reserve. Because we paid 100. In return, the capital reserve and surplus, which is more than 100 we are getting. So we getting something more in return. So we call it's a profit for us, and it's not a revenue nature profit, it's a capital nature profit. That's why they call it capital reserve. But remember these steps that here, okay? So if it is coming positive, goodwill, if it is coming negative, then it's a capital reserve. Okay, don't worry. Even if you understand 50% what I've discussed till now, it is more than enough, because when I'm going to discuss the question, all these steps is going to come there, and don't worry about these adjustment. There is the one in repeat this in section 6, all the adjustment are given one by one. So I'm going to discuss all these adjustment with you. So don't worry for that. One by one, I will discuss each of them with you. Okay. But time being understand 4 notes to account, 4 what here? Working note. That here. What is the biggest task that you have? These highlighted figure. Analyze the profit of subsidiary company. And these 2 figures will not appear directly in consolidated balance sheet. And this investment in subsidiary company will not appear directly in balance sheet. Okay. Where this reserve and surplus will go? Minority belong by these green. Where the share capital and reserve and surplus will go? Whatever belongs to minority, it will go in minority. Now, where this what about the holding company? Pre-acquisition profit and portion of in the capital that will deduct from the cost of investment. Post-acquisition profit will add to the profit of the holding company. This, if you know that how to prepare, if you're able to analyze the profit of the subsidiary company, then I promise to you, when we are to discuss the question now, you have to read it, and if you're able to do the analysis part here, done 100%. I'm sure you are going to score full marks in that. Now, what we'll do that here, there's so many adjustments in these chapters. I will discuss with you one by one. But let's start with come to Super 50 question. Let's start with first question of consolidated financial statement. So come to the question number 35. And also their consolidated profit and loss account. There's so many things. Uniform accounting policy. There's so many. I will discuss with you all of them. That let's go one by one. Now come to question number 35. Prepare consolidated balance sheet of H Limited and its subsidiary as at 31st of March 2021 from the following information. Now understand this question. This is a simple question. As it is first question, it's a simple question. Always remember that 3 figures are important here. First of all, they give you the balance sheet of holding company and it's a subsidiary company, H Limited, subsidiary company, S Limited. Now, PP is 5 lakh, 3 lakh investment. So, 2000 equity shares of S Limited, that is the holding company purchased 2000 equity shares in subsidiary company. What is the cost? 2,20,000. Then current asset 1,55,000 and 1 lakh. Share capital fully paid up equity shares of rupees 10 each. That is 5 lakh, 2,50,000. Profit and loss account 2 lakh, 1 lakh. Trade paper 1,75,000, 50,000. H Limited acquired the shares of S Limited on 31st of March 2021. Now we will analyze this question. First question, that's why it's a simple question, but always remember that. I told you that these 3 figures are important. That the share capital and reserve and surplus of subsidiary company and investment done by the holding company and subsidiary company. Okay. Now, if you see that here now, what happened now? This is the investment done by the holding company and subsidiary company 2,20,000, and share capital of the subsidiary company is 2,50,000, and profit and loss account they have how much is 1 lakh that. Okay, now understand this point here. Now, they say H Limited acquired the shares of S Limited on 31st of March 2021. What is the date of balance sheet? The date of balance sheet, if you see that here, the date of balance sheet is 31st of March 2021, and what is the date of acquisition of shares is also 31st of March 2021. It's the same date. So what you can do that here, for every question I have done the analysis here. What you can do that now here, you can pause the video later on, you can write it down. This is question number 35. Now understand, what is the date of balance sheet here? 31st of March 2021, correct? What is the date of acquisition of shares by holding company and subsidiary company? That is also 31st of March 2021. It means there is no post-acquisition profit here in this question. Why there is no post-acquisition profit here in this question? The reason is that here now, because the date of today only, they acquire the shares and today they are preparing the balance sheet. You got the point that here. So whatever the profit which is given here, it's a pre-acquisition. There is no post-acquisition here, okay? Because we acquire the shares today and we are preparing the balance sheet today. So there is no post-acquisition profit. So when always first, what you will do that you try to analyze the profit that year. So this is the profit of the subsidiary company, which is given 1 lakh. So when I analyze between the pre and post, obviously the 1 lakh is the profit on the date of acquisition. We are also preparing balance sheet on 31st of March 2021 only. So whatever profit that they have, this profit is on the pre-acquisition profit. because this is the profit which existed here. So now we are preparing the balance sheet here only. So there is no post acquisition profit here. So that's why this profit is the pre-acquisition profit. So in every question, roughly draw it somewhere that in examination also try to analyze it, the profit of the subsidiary company in the pre and post that. Okay. Now, how to prepare that? So when you will see the study material of ICA, that obviously they prepare balance sheet, but when they prepare the notes to account and working note and all, obviously final answer will be same. But to make it simple, I have my own way of preparing all these working note, okay, and this notes to account. Because when you will see, with due respect to ICA, when you will see their study material, it is very confusing when you see the working note that here. So the way I explain you that here about the notes to account and working note, in the same way you are going to prepare it, okay. So you can see that now here is equity and liability, share capital, reserve and surplus, minority interest, current liability. Now it is up to you. If you want, you can make a notes to account, not necessary, but these three are compulsory: share capital, reserve and surplus, and minority interest. They make a notes to account on trade payable as well, no problem. Then they have is a PP and the current asset. Now notes to account that they have prepared. Okay, so first here notes to account that they have prepared on here is share capital, then reserve and surplus, minority interest, that now trade payable, PP, current assets. So not necessary that you have to prepare on trade payable and current assets. Okay, but if you want, they can do that. Okay. Now here they say here, first of all, these are notes to account. Okay, just give me, I think it's twice. Okay. Just give me a minute. Okay, this is solution that here. Okay, just give me a minute. Solution, but okay, by mistake that here, no problem. Okay, I think that these are notes to account, share capital, trade payable, PP, current asset. Okay, yeah, and working note that here. Okay, now understand that. I think they have prepared these notes to account that they have given here. I think twice that here, 2,25,000. Just give me a minute. That now here is F5. Okay. Anyways, by mistake that in your notes also that here, the two times that they have prepared this notes to account. Okay, but let me prepare in my way that only. It's okay that you know these notes to account, you can ignore it. By mistake, two times that they have prepared this notes to account, no problem that here. Okay, now listen carefully. So we have prepared notes to account on share capital, reserve and surplus that here, minority interest, trade payable, PP that here, and the current asset. Okay. Now working note, I told you how many working note? 4. First working note is on what? Here, shareholding pattern. I will explain each and every shareholding pattern. Then second is analysis of profit of subsidiary company. Third, I'll tell you that goodwill or capital reserve and adjusted profit and loss account of holding company. So just listen me carefully. So here we have prepared notes to account that we have prepared is 4 notes to account which you have to prepare. That is here share capital. Okay. Then reserve and surplus, minority interest. Okay. And then PP. But they have prepared it, not necessarily. Okay, then they have prepared trade payable and then current asset. 6 notes to account and these 4 working notes. Now, how to solve the question? Okay, one by one. So what we'll do that here now? PP, that how much is the PP? Remember, these 3 figures are very dangerous figure in every question that day. Okay, so these 3 figures are very dangerous that day. Investment in subsidiary company and the share capital, reserve and surplus of subsidiary company. Okay, the one by one. PP is 5 lakh and 2 lakh. We made a notes to account on it. Yes. So we'll go to notes to account on it. 5 lakh and 3 lakh. Share capital. You can see that 5 lakh and 3 lakh. Simple. Then we have here, I told you that here, this investment in subsidiary company will never appear directly in consolidated balance sheet that year. So what we do that here, we show in a working note number 3. Working note number 3, it will always come how much investment we have done in a subsidiary company, because this investment which we have done and we find it a goodwill or capital reserve. So investment minus, you know that I will go to that format. So it will how much the cost of investment that we consider while we calculate goodwill or capital reserve. So that will go working note number 3. So when I go working note number 3, you can find it out that in a cost of acquisition is how much? 2,20,000. What is this? Dividend out of pre-acquisition profit. I will discuss with you later that, but here in this question it is 0. So 2,20,000. Okay. Then we have here is current asset 1,55,000 and 1 lakh. So we made a notes to account on it. 1,55,000 and 1 lakh. So 1,55,000 that here now current asset. Current is 1,55,000, and how much is the 1 lakh that is coming. Okay, total we'll do it later. Then we have here, what we have that now here is the share capital. Now I'm share capital. These share capital will go to share capital. These figures are dangerous. The point that I've highlighted here. Okay, these are dangerous that here. So this share capital of this 5 lakh will go in share capital. So I will go to share capital. This 5 lakh I will write it down. This is 5 lakh. Okay. Then we have here, they have mentioned the shares of rupees 10 each, so 50,000 shares of rupees 10 each. I will come to it, don't worry. I will come to these 2 points, okay, don't worry. Now here, profit and loss account, it will go to reserve and surplus, 2 lakhs. So notes to account number 2. Okay, one more thing that here. Now when I say this, basically it should go to reserve and surplus only. That is notes to account number 2. But what we do that here now, there might be certain adjustment in that here, okay. So what I do, I always prepare a working note number 4 for these profit and loss account of the holding company, profit and loss account balance of holding company. So how much balance we have here? 2 lakh. So what we'll do that here, this 2 lakh will go to working note number 4. Later on, we'll see if there is an adjustment. We will adjust that, and then it will come to what? Where it will come? It will come to reserve and surplus only. So go to working note number 4. You can see that here working note number 4 will always be on what? Profit and loss account balance of the holding company. So you can see the balance brought down. How much it is? 4 lakh. So this much balance we have write it down 4 lakh there. Sorry, 2 lakh, not 4 lakh. So you just have to write it down here. How much here it is? 2 lakh. That okay. Basically, it should come in reserve and surplus. So we'll see that if any adjustment comes. So we have to do that. I will discuss with you. Don't worry for that. Then we have here, what we have here, we have now is the trade payable, which is how much? 1,75,50,000. So we made a notes account on it. So 1,75,000 trade payable, 1,75,000 and how much? 50,000. Okay. Now understand this one. Do you remember that what we have to do for these 2,50,000 share capital of subsidiary company? We discussed it there. We discussed it there about the 2,50,000 that here. Now is this the share capital? Share capital. Okay. So 20, whatever is the rate, we will find it out that here. So deduct from the cost of what? Investment. Deduct from the cost of, you can find it in rapid gist as well that here. If you go to rapid gist that here, it is mentioned in rapid gist that here, this. Okay. Same that here now. This is the profit they're talking about. Okay. So this is the profit that they have. So you can see that here now. Okay, this is the profit. Okay, so pre-acquisition, and we are talking the share capital. Okay, so share capital, what we have to do that? Minority interest that here. So whatever ratio of the minority interest, it will go to notes to account number 3, because notes to account number 3 is on what? Minority interest that here. Okay, and whatever belongs to the holding company, that will deduct from the cost of investment. That is working note number 3. Always like that. Okay, working number 3. So before that, I have to find it out how much is the shareholding pattern. So out of 2,50,000, we purchase basically 2,000 shares. How much shares that they have? 2,50,000 is the total amount of share capital divided by 10. So basically out of 25,000 shares, we hold out of 2,005. Oh, it can be. Just give me a minute. There is some correction should be here. Just give me a minute. That the shares is that they have not mentioned properly that there. Yes, 20,000 shares should be here. Okay. So there is a one correction here that here. This is not 2 lakh. This is not 2,000. This is 20,000 shares. Okay, do the correction in notes that here. 20,000 shares. Okay. So out of how many shares that the subsidiary company has? 2,50,000 is the total amount. Divided by 10, that will come how much? 25,000 shares. So out of 25,000 shares, we hold how much? 20,000. So shareholding pattern always be working on number 1. So 20,000 shares we hold. So total is how much? 25. It means remaining hold by minority. So I will say that here out of 25,000 shares, if I hold 20,000 shares, it means remaining hold by the outside minority. Now if you calculate percentage wise here, so 20 divided by 25 multiply 1, that is 80%. Here it will come 20%. So it means that shareholding pattern is coming how much? 80% and 20%. 80% holding company, 20% what? Subsidiary company, this minority. Now here I will say that share capital, 80% in our case that here will be deducted from the cost of investment, and 20% of minority interest will go to notes to account number 3. So how much share capital that they have? They have a share capital, how much share of rupees, how much share? 2,50,000. How much share capital that they have? 2,50,000. So 2,50,000. So what two treatment we have to deduct from the cost of investment? Working number 3. So go to working note number 3 that now here you can see that working note number 3. You can see that working number 3. So here 2,50,000 multiply by 80%, 2 lakh. We'll deduct it total. It will deduct from here. Okay, 2 lakh. It will come later on. I will come to that. 2 lakh will deduct it. Okay. Then what we have to do that for these 20%? Note stock on number 3. So go to note stock on number 3. That is 2,50,000 multiply by 20%. That is coming how much is the 50,000. So 2,50,000 multiply by 20%. That is coming how much is the 50,000. Okay. Then we have here pre and post acquisition with profit. We analyze that here. But if we go to this question that now here is how much is the profit that they have 1 lakh. But what is the date of acquisition here? Date of acquisition of the company is the same the date of balance sheet. So we are preparing the balance sheet today and we acquire the shares today. So all the profit of the subsidiary company is only pre-acquisition. So now what we do that here, we make a working note number 2 always that here on the analysis of profit of the subsidiary company. So if you go to the working note number 2, you will see that here now is the pre-acquisition profit and the post-acquisition profit. They have a profit of 1 lakh rupees, so it will come in a pre-acquisition profit only. Okay, done. So we have covered all items. Now we'll close one by one. All these first working note will close. So first is okay, shareholding pattern. Second, I will do the total here 1 lakh. Here it is 0. So 80% holding, 20% holding. So 80%, 80,000 here and 20%, 20,000. What we do that here? Go to again repeat is that now. Now there is no post acquisition profit here in these question. Only pre-acquisition profit. Okay. Holding company profit deduct from the cost of investment working number 3. So what I will do that I will deduct this 80,000 here. I will deduct from 80,000 here. Okay. Okay. It will go to working note number 3. Okay. Now what about this? The minority pre-acquisition profit. Minority that here pre-acquisition profit will go to note stock on number 3. So it will go to note stock on number 3. Note stock on number 3 minority. You can see that minority that is 20,000. Okay. Here in this question there is no post acquisition profit. That's why here minority it is on 0. And this profit basically you'll add to the profit of the holding company. But there is no post acquisition profit. In next question it will come. I will explain you there. Okay. Now done. So if I go to again this working note number 2. Okay. We have write down the value of working number 3. So here total is coming 2,20,000. But how much basically we have done the investment of 2,20,000. How much that they have given us in return that is 2,80,000. So 2,20,000 minus 2,80,000 that is coming how much here? 60,000. It's a negative figure. So we have given them less amount. How much we have given? The cost of investment was how much? 2,20,000. How much we get in return? 2,80,000. So we are getting more. It's a benefit for the company. So that's why we call it capital reserve. So where capital reserve we write it down, it's a reserve. So it will come under reserve and surplus. So go to reserve and surplus. That is note stock on number 2. You can see that capital reserve here, how much here? 60,000. Follow these steps only. Okay, then we have working number 4. There is no post acquisition profit because the post acquisition profit, whatever the portion of the holding company, we add to the profit of the holding company. But here in this question, there is no post acquisition profit at here. Okay, that's why only 2 lakh will come the balance. It will go to again reserve and surplus that here. If it's come goodwill that then that we show in a balance sheet as intangible asset. So here it will go to this 2 lakh. It will go to reserve and surplus. So note stock on number 2, 2 lakh. So note stock on number 1 total is 5 lakh. Write down in balance sheet how much is. You can see that 5 lakh. Note stock on number 2 total is at 2,60,000. So note stock on number 2 is how much? 2,60,000. Note stock on number 3 total is how much? 70,000. How much it will come here now? This 70,000. Note stock on number 3 is 2,25,000. That will come here 2,25,000. Okay. Now here note stock on number 5 is 8 lakh. 8 lakh. Note stock on number 6 is coming how much? 2,55,000. So here it will come 2,50,000. Now total of balance sheet. You got the point? So don't worry that. I know that say if this first question is very simple, but why I have covered this first question here? The simple question. You should know the structure. How to solve the question. The biggest part in every question is to analyze the profit in the pre and post. Here in this question, there is no post acquisition profit. But now in coming question, the pre and post, everything will come that here. Advanced adjustment will come and you don't worry. All the adjustment mentioned in repeat this and those will come in question as well here. So when I will go through the question, I will explain you the adjustment. I will go to repeat this and then I will explain you from there. Okay, you got the point. So those who are watching this lecture, don't worry that here. First watch full lecture. Okay, first watch full lecture that is. Then after the lecture, try to do the practice of all these questions in the same manner I'm explaining you. But meanwhile, when you're watching the lecture that here now, please, in every question I have done the analysis. These analysis I will explain you. Detail analysis I will do that. Okay, these analysis. So with me, write down all these analysis. So I have covered just question number 35 on simple question. Now 34 little bit advanced. 36, 37 little bit more advanced. Okay, 37 more adjustment will come that here. I will explain it there. Okay, don't worry. 35 done. Simple question. Now what we'll do that here now. We'll come to question number now 36, but you know the structure how to solve the question that here. Okay, now please come to question number 36. White Limited acquired 2,250 shares of Black Limited on 1st of October 2020. What is the date of acquisition here? The date of acquisition is 1st of October 2020. The summarized balance sheet of both the companies as on 31st of March 2021 are given below. So the date of acquisition is 1st of October 2020 and the date of balance sheet is 31st March 21. So just first listen that here. Okay, when you can pause the video and draw, this is important that here. Okay, now year started on 1st of and on 31st of March 21. So obviously it started on 1st of April 2020. Okay, so listen carefully. Year started on 1st of April 2020, which ends on 31st of March 2021. This is date of balance sheet. On this date, we are preparing what? The consolidated balance sheet. And this is the date of acquisition. This is the date of acquisition. Okay, then it says that here now, White Limited. Okay, now this is a holding company because White Limited acquires shares. How many shares they acquire? 2,250. So it will help us to find it out the shareholding pattern. This is a holding company, subsidiary company. Okay, let me write holding company, subsidiary company. So equity and liabilities, shareholders fund, share capital, equity shares of ₹100 is fully paid up. So 3 lakh. Okay, this is share capital subsidiary company. I told you, be careful in the share capital subsidiary company, reserve and surplus that here, and we have these 3 things. Okay. Then this says that here now is the reserve and surplus, 2 type of reserve. I mean, under reserve and surplus. General reserve 60,000 and 30,000. Profit and loss account 1,50,000, 90,000. Then we have current liabilities. That is the, I think the figure. Okay, no problem. Current liabilities, that is the trade payable 1,50,000 that here, 1,15,000 and 75,000. Due to White Limited, it means what is due to White Limited? There are 2 companies here, holding and subsidiary. So due to, we call it new concept I will teach you, intercompany dues we call them. So due to White Limited, it means this is a holding company. What's the name of the holding company? White only. So this is white and this is black. Okay. That is appearing in the balance sheet of Black Limited. Due to white means they're liable to pay. So it is a liability which is appearing. I will tell you what we call them mutual debt. I will discuss with you. So subsidiary company says that he is liable to pay to the holding company 30,000. Okay, we'll discuss about it. Don't worry. Then asset side here now is non-current asset, property, plant and equipment 5,80,000, 3,50,000. Investment shares in Black Limited 2,250 shares purchased by the holding company subsidiary company 2,70,000 amount. Now here current asset. Now current asset inventory is that here 50,000 and 1,20,000 due from Black Limited. So one company says that holding company say which is receivable from the subsidiary company is 36,000 and the subsidiary company says payable to the holding company 30,000. How it can be? Suppose I am holding company but you are subsidiary company. I am saying the amount which is receivable from you is 36,000 and you are saying the amount payable to me is 30,000 that year. So amount should be same. It might be happen payable receivable between these 2 company holding subsidiary might be happen. But amount should be same. So we'll come to reconciliation part why the amount is not matching it. Something should be mentioned in question. But this is a concept of the mutual debt or we also call them intercompany debts. Suppose I am holding company, beta, you are subsidiary company. Okay. So when I prepare my individual financial statement, I will write it on each and everything what is payable, receivable, even though something is receivable from you. When you prepare your individual financial statement, we will write it down that payable to me, that 30,000 which is appearing here. But when I say when we prepare consolidated, what do you mean by consolidated? Consolidated means we are considering as the same company. When we merge it, so it's treated as the same entity. So when we merge it that here, now you yourself imagine that there is a consolidated balance sheet. On one side it is appear as a receivable. On one side it appears as payable. Do you remember the amalgamation chapter? So when these point came there all, but there it was a purchasing company and vendor company like that. Okay, here holding and subsidiary. But when we prepare consolidated balance sheet, so for the purpose of consolidated balance sheet, same balance sheet of receivable and payable will appear. So we have to cancel that here. But amount should be same, that I agree. But here the amount is not matching. You can see the point that I've highlighted with green color here. So amount should be matched. Here it is appearing 36,000 and 30,000. It should be same. We will cancel that, but it should be same that here now. So this is a new point where we'll discuss the intercompany dues we call it. But why it is not matching, we'll discuss that. Then they say that here now. Okay, now you just have to write it down. If you want, you can pause the video, but you have to write it down whatever. Then they say, first of all, they say first information. During the year, Black Limited fabricated a machine which is sold to White Limited for rupees 39,000. The transaction been completed on 30th of March 2021. Basically, it is saying that here now, subsidiary company sold the, okay, subsidiary company actually sold some machinery to the holding company. There is a concept of the unrealized profit, but here they have not given much information. They just say the subsidiary company sold to the holding company the machinery of 39,000, but how much is the profit made by them? So it is irrelevant for me. Okay, similar adjustment will come later on. I will discuss there. But for me, for this question, it is irrelevant that day, because the subsidiary company sold something during the year to the holding company. But what is the profit? What is the profit that should be, that they should mention as that year, but it is not mentioned as that year. So we'll ignore this point that year. Now they say that cash in transit from the Black Limited to White Limited was rupees 6,000 on 31st March 2020. I will discuss with you this point later on. Profit during the year 2021 were uneven, means equal, same every month equal profit happens. That why they are telling you, I will tell you later that year. Even though if it is not mentioned, we assume the same. I will tell you later on. Don't worry. Now this is interesting. The balance of reserve and the profit and loss account as on 1st of April 2020 were as follows. Now they give us the opening balance of both the company, holding company, subsidiary company, reserve and surplus. So the holding company is a White Limited beta. For these White Limited, these information is irrelevant for us. Why? Because we have to analyze the profit of subsidiary company, not holding company. Okay, here in these marathon, I will not go here and there. I will just focus on the content that here. Okay, I'm just the content I will talk about, because every minute is very important here. Okay, so I will just talk about the content only, what is important for you. Okay, I will not discuss here something else that is, just focus here. So we just have to ignore it. Irrelevant for me. This is irrelevant for us that. Why it is irrelevant that here? Because we don't analyze the profit of holding company. We are going to analyze the profit of what? Subsidiary company. Now understand this. Okay. Now first challenge, always before you start the question, first step you have to do, analyze the profit of subsidiary company. So what we'll do that here now? We will analyze the profit of subsidiary company here. Okay. So they say how much is the reserve that they have here? They have a reserve of 30,000 at the start. They have given the date 1st of April 2020. So they have the reserve 30,000. So let's analyze that here, 30,000. Okay. Now let me write it down here. You can see that the general reserve I have written here how much? 30,000. Okay. Just listen first, then pause the video and then write it down later on. So how much general reserve we have at the starting of the 30,000. But when I go to balance sheet that here now, at the end of the year also, the reserve is appearing how much? 30,000 only. So the starting of the year reserve was 30. At the end of the year it is 30 only. So it means there is no change here. Starting it was 30. At the end of the year it was 30 that year. So there is no change here. Is there any change here? No. There is no change here. It is same during the year. Okay. So it means this is the date of acquisition that way. This is the date of acquisition. We have to bifurcate pre and the post that way. But here it was 30 and here it is also 30. So there is no change during the year. So what is going to happen now? The complete general reserve balance that we have, it means that profit belongs to the pre-period only, because at the starting it was 30, at the end it was 30. So there is no change, there is no addition or subtraction during the year. So whatever general reserve, that is pre-acquisition. So remember, just write it down with you. Okay, pre that here. Okay. Now what we'll do that we'll analyze the second part of reserve and surplus P&L. So how much balance we have P&L? They mention the loss we have. We have a loss. So at the starting of the year. So I write it down here. Profit and loss account balance 10,000 is what? Loss. Once you able to analyze the reserve and surplus subsidiary company, the major task has been done that year. So it says that 10,000 is the loss that way. That's why I write it down here as a negative figure. This is the 10,000 loss that way. You got the point here? Now, they say how much we have at the end of the year. So when I go at the end of the year, we have here how much is this coming? 90,000 is the balancing. Closing balance is 90,000. So here I have a balance of 90,000. So what do you think so that now? At the starting of the year, if there is a loss of 10,000 that here now, loss of 10,000, and at the end of the year we have a profit of 90. It means at the end of the year the balance is 90. So it is not from 10 to 90. It is from loss 10 to the profit. The closing balance is 90, which is profit. It means we made a profit of 1 lakh during the year. You understand? We have a negative figure at the starting. If we have a negative figure at the starting, and if we have a positive figure 90 at the end, so there should be a profit in the 1 lakh only. That is minus 10,000 plus 1 lakh. That will come 90,000 positive figure. You got the point? It means if we have a loss at the starting of the year of 10,000, at the end the balance is coming 90. It means during the year we made a profit of 1 lakh. Initially there was a loss balance, 1 lakh profit. That's why the closing balance is coming 90,000. Now understand this one. So from negative 10,000 to positive 90, it means we made a profit of 1 lakh. But these 1 lakh we have to bifurcate between pre and post. Okay. What is the date of acquisition? The date of acquisition. Okay. The date of acquisition. This is the date of acquisition. 1st of October 2020. So these 1 lakh this is for the whole year. So 6 months come in pre-period. You can see that a pre-period that here. Let me write it down. This is a pre-period. How many months here? 6 months. The post period. How much here? That is coming how much here? The 6 month that here now. So what is going to happen now is the pre-month is 6 month, post is a 6 month, because the year ends on 31st March. They acquire the control on 1st of October. So these 1 lakh will be divided into 6 equally. That's why they mean how much it will come? 50-50. Now some of you may argue, no, sir, it might be happen that major profit happens in first 6 months, then less amount. It might happen, but always we assume equally. And they also specifically mention in the question that here in point number 3 that here, the profit during the year 2021 will earn evenly, means equal profit that year every month. So even though they have not mentioned, we assume the same thing that year. In equal ratio that year, this I'm just some may argue that 1 lakh, but they may argue that in the first half they made 80 and the remaining they made 20. But we'll assume evenly that they have made. So equally just we have to distribute 6 that will come 50,000. It's almost done. Once you've done this part, the chapter is so simple. Then this question will be so simple that here. So when you will make a notes to number, working note number 2, analysis of profit subsidiary, just we have to write it down there. These general is a pre this 30 profit and loss account, negative pre 10,000, and the pre positive will write it on 50 and positive post 50. That's it. If once you have able to do this, then done that. It is very simple chapter. Trust me. Okay. Now I will explain this what is cash in transit and other point as well that here, but you should know the strategy. What we will do that here, beta, first we'll draw the balance sheet. So you can see that here now. Just first listen me that here, okay? After the session, you have to do the practice of whatever the question is given here, okay? Now you can see that here now, consolidated balance sheet of White Limited and its subsidiary company. Equity and liabilities, shareholders fund, share capital. Okay, first minority and the current. No, there is no non-current liabilities. That's why they don't have to write it down. But you can write it non-current, current and all. Then we have asset, non-current asset, current asset. Okay, now understand this. Now how many notes to account? 4. Share capital, reserve and surplus, minority interest. Trade payable not necessary, but they have to say, okay, trade, you can write it in inner column and both the figure add and write it down there, holding a subsidiary company figure, but it's okay. Trade payable, they have prepared PP, inventory, cash and cash, so many notes to come, but 4 is mandatory, you have to make it that, okay. What are the 4 that here that they have? Capital, reserve and surplus, and then minority and PP. Here this is the adjustment of cash in transit that will come in. Cash and cash. They have made it. Okay. How many working notes? 4. What are the 4? What are those 4 working notes? Shareholding pattern. Shareholding pattern that here now. Analysis of profit of subsidiary company, goodwill or capital reserve, and adjustment of profit and loss account. These 4 working capital. These are the working notes. Same. Okay. So once you have drawn this, always try to sort the shareholding pattern also initially. So how many shares that we have acquired here? We acquire here, it is mentioned that now 2,250 shares. How many total number of shares of subsidiary company? 3 lakh is the amount, and 100 is the share. So 3 lakh divided by 100 is a per share. That is 3000 shares is coming. So if I go to shareholding pattern, you can see that here now shareholding pattern. So we hold 2250. Total number of shares is how much is 3000. So balancing figure will come 3000 minus here 2250. Okay, 2250. So how much it will come? 750 it is. Okay. Then here you can calculate now 2250 divided by 3000 multiply by 100. That will come 75% here, and it will come how much? 25%. Okay. Now we'll start balance sheet one by one. So first item we have that here, where this will go 6,50,000 share capital. Okay, so 65,000 shares, no, 6,500 shares of rupees 100 each. Remember these figures are dangerous. These figures, capital, reserve and surplus, subsidiary company, investment we have done. Okay, so 6,50,000. Where it will go share capital. Note stock on number one. So note stock on number one, 6,500 shares of rupees 100 each. How much it is coming? 6,50,000. Then we have here reserve and surplus. General reserve, it will go in reserve and surplus. How much is 60,000? So we will go here in general reserve, that is 60,000. Okay. Then we have profit and loss account. It should also come in reserve and surplus, but there might be some adjustment. That's why we make a working note on it. Always working note number 4. Okay. Later on the balance of working number 4 will come in reserve and surplus only. 1,50,000. So working note number 4. 1,50,000. Just follow this instruction that here. Okay, we will get 14 out of 14. Then we have here is the current. I will come to, okay, let's hear it. Now I will go to the analysis part. Let me first finish this. Trade payable 1,15,000 and 75,000. So 1,15,000 and 75. Trade payable, they made a note stock on it. Okay, so 1,15,000 and 75,000. Okay. Then we have here it's a mutual debt. It is coming 30,000. Okay, just for you, let me draw this in the books of White Limited. Let me write in the books of, no, this is Black Limited. So there is a white account, mutual white account. So they have a balance of payable. It is coming 30,000. Okay, we'll discuss about it later on. Okay, now on here, let me write it on for also in the books of White Limited. Now there is a Black Limited account. Okay, so they have a debit balance. It is receivable from them 36,000. Okay, we'll discuss about that. Okay, now before I come to asset side that here, now let me finish that. So this what we do for these 3 lakh. Do you remember this? We discussed in repetition. Share capital 3 lakh. So here the ratio is 75%, 25%. So deduct from the cost of investment working number 3. So amount is 3 lakh. So I will go to working note number 3. Working note number 3, I will deduct it from 3 lakh multiplied by 75%. That is coming 2,25,000. Then what about the remaining 25%? Note stock on number 3, write down there. So note stock on number 3, I will go. Note stock on number 3 is minority 3 lakh multiplied by 25%. That is coming how much is 75,000. That is coming how much? 75,000. Then we have here, we will analyze this pre and post that later on that, but I'm going to say we will do this where should we write, but before we have to analyze that here. So you can see that here they have a general reserve of how much? 30,000. We already discussed about this general reserve. All are the pre only. So where we do the analysis of profit of subsidiary company, always working note number 2. So I will go to working note number 2. We'll go to working note number 2 that here now. You can see that in working note number 2. See how simple it is that here. Working note number 2. Analysis of profit of what here? The subsidiary analysis of profit of subsidiary company that. Okay. Now how much it is that here? Pre 30,000. Simple. Okay. Then here. Then we have here how much is 90,000. So we discuss about this 90 because the opening is given negative 10. So this 10 will go in pre. Let me discuss with you. 10 will go in pre. So you can see that here now is how much is the pre that we have here. The pre is negative. This is pre and this is post. Okay. This is how much here? Is it 10,000 is the pre. Okay. Then we have here. This is 10,000 is the pre. Okay. Negative. Then we discuss about that here now is total, if the end closing balance is 90,000, it means during that there is a profit of 1 lakh. So equal 50-50 because we acquire acquisition whole mid of the year. So pre 50,000, post 50,000. So you can see that now is 50,000, 50,000. Simple it is. Okay. Now again come to balance sheet here now. So when we come to balance sheet here now, that here, okay, done liability side. About these 30 and 36 mutual debt, I will discuss with you. Now PP. Now here 5,80,000, 3,51,000. So PP notes to account on PP. Notes to account PP, that is 5,80,000, 3,51,000 here. Okay. Then we have here investment in subsidiary company. How much investment? 2,70,000. What we do that? It's a dangerous figure. Okay. What we do that here? This investment, I told you that here. I told you that what we do that investment that here, we basically write it down in working note number 3 as the cost of investment. Okay. So do you remember that we discussed initially that here this, okay, we show as a with cost of investment always. So what we'll do that here now is, okay, so let me go to cost of investment. How much is the amount of where that we have done the investment? 2,70,000. So we'll go there here and 2,70,000 that here now. Okay, 2,70,000. Simple. Okay. Again, come to balance sheet here now. Then we have inventories 50,000 and 1,20,000. So inventories, we made a note stock on it, 50,000 and 1,20,000. Okay. Then we have here is again mutual debt. I make in the books of the white limited, this is the black limited account 36. I will discuss about it. Okay. Cash and cash equivalent, we made a note stock on it, 39,000 and 54,000. So cash and cash equivalent 39,000 and 54,000 is that. Okay. Then one by one discuss this. First point, it is I mean to say this is the concept of the unrealized profit. We have not yet discussed those points. We'll discuss about it, but here it is irrelevant for me because they told me that at what price we sold it that year, but didn't mention how much the profit that they have made. So this is the concept of unrealized profit will come later on. We'll discuss there. We'll see some adjustment on it as well. But here it is irrelevant for me because how much profit that they have made, it doesn't mention in question. So just ignore that part. Now, interesting part. This the cash in transit from black limited to white limited was rupees 6,000 on 31st of March 2021. So basically some cash sent by the black limited to the white limited 6,000, which is still in the transit, which is not received by the white limited. So in the books of white limited, if they receive the cash, what entry they will pass? Cash account debit. Like when you receive from the customer, what entry we pass? Cash account debit to debtors account. So I will say, I cannot say cash account debit because we have not yet received the amount which is still in transit. So we are going to pass entry cash in transit account will be debited. So I will say that here cash in transit account will be debited to black account. Black is the name of the other party. Okay, in the books of white limited. So write it down for reference. Cash. Suppose you receive a cash from black limited. What entry do we pass? Cash account debit to black limited account, but which is not yet received. That's why we are saying which is in transit. The cash in transit account debit to black limited. Write down this entry. Okay. So where this cash in transit will come? In cash and cash equivalent. So I will go to cash and cash equivalent. You can pause the video if you want to write it down anything, just pause the video and write it down. But listen me carefully that, okay? And trust me, at the end of the session, you will be able to understand each and every concept. And I will just discuss on the concept here. Your each and every second is important. Okay. Now this cash in transit account debit to black. Okay. So cash in transit, where it will come? In cash and cash equivalent. So you can see that here notes to account on cash and cash, you can see that it's 6,000. This is the first effect. The second effect, I'm going to credit to the black limited account. So in the books of white limited, I will credit to 6,000. Okay. Now understand. If I do the balancing here now, how much balance is coming here now? Here balance is coming credit balance 30,000. Here balance is coming debit balance 30,000. Not is stated that here. Okay. So in subsidiary books of account, it is coming credit balance. In holding company books of account, it is coming what? Debit balance. So if I am holding company beta, you are subsidiary, I am saying the amount is receivable from you. And you will say amount is payable to me. So in our individual financial statement, we will write it down. In my individual financial statement, I will write it down. In your individual financial statement, we will write it down. But when we prepare consolidated financial statement, we consider as a single entity only. So it should be cancelled. We call them mutual debt. What we call them? We call them mutual debt. Okay. We call them what? A mutual debt. This is the point that way. Okay. Now elimination of intercompanies here. Elimination of intercompanies that way. Deduct amount from the debtors, trade receivable and the creditors that here. But they have mentioned separately to this heading that here basically when we cancel to both of them, it will be 0. So from asset side, these will be 30 will be cancelled, and here from the liability 30 will be cancelled. So no need to write it down. We have not write it down this due to white limited, due from black limited. Okay, we have not. If we write it down, write down then cancel. Ultimately, it will be 0. You got the point? Okay. Now we have done with all the adjustment that here. Okay, now first what we have to close on, always working note. So come to working note better than first working note. Okay, that is shareholding pattern. Now second, how easy it is once you're able to do the in a pre and post. Once you're able to do in pre and post. Okay, so that third here, if you do the total 70,000 and 50,000. 75% of 70,000, that is coming 52,500, and this is coming 17,500. Now 75%, 25% of 50,000, 37,500 and 12,500. You got the point here? Okay. Now what happened here is that now here, now understand this point here. How to allocate? I'm going to say just focus on these table that here. Okay. Now just let me go. Now we find out this pre and post, both we have here. Be careful. So holding company, what we do that we are talking the pre, and then we discuss about the post. Okay. Deduct from the cost of investment, working number 3. So I will go this 52,500, deduct from the cost of investment, working number 3, 52,500. Okay. Then here, this write a note stock on number 3, this minority interest, 17,500. So note stock on number 3, 17,500. Okay. Follow these 3 steps. Now post acquisition. So what about this holding share that here? Write it down in working number 4 that here. This we add to the profit of the holding company. So I will see that this is a holding company. The post acquisition profit 37,500. So we will write it down in working note number 4. Okay, so working number 4, credit them. Increase the profit, it should be credited. Decrease in profit, debit. So it's a profit, we'll credit them. Then what about this 12,500 post acquisition profit minority? Post acquisition profit minority, write down in note stock on number 3. So I will go to note stock on number 3. And I will write it down that in a 12,500. How easy it is that? If you follow these steps, very easy. Now working note number 3. So 2,70,000 minus 277,500, it's coming again negative. It's a capital reserve. Where this capital reserve will go? Reserve and surplus. So I will go to reserve and surplus, note stock on number 2, and you can see that 7,500. Okay. Then here, last year, it is totally here it is coming working note number 4, 1,87,500. It will go again reserve and surplus. So initially we don't write it on this P&L account, balance of holding company, reserve and surplus, because we have to do certain, might be there's some adjustment as it comes here. This post acquisition profit, we write it down 37,500 here. Now total is coming 187,500. I will write it on reserve and surplus, 187,500. Okay. Now one by one, close every note stock account. First is 6,50,000, 6,50,000. This 2,55,000, 2,55,000. Then here 1,05,000, 1,05,000. Then note stock on number 4, 1,90,000, 1,90,000. Note stock on number 5, 9,31,000, 9,31,000. Note stock on number 4, 1,70,000, 1,70,000. Note stock on number 7, 99,000, 99,000. 14 marks is yours now. You got the point? How simple it is that here. Very simple that here. Okay. Imagine, I'm trying my best to finish. I'm just to convey each and every adjustment that here. Okay. But in regular batch, obviously I saw all these in detail. It's take me so many 12, 15 sessions, 3 hours. Okay. You can imagine how detailed discussion happens in regular batch for these chapters. Okay. Anyways, that, but still here in this short session only, but I'm as it is a marathon that here. So we will focus on the content that here without I'm missing any point. Each and every point I will discuss with you here. Okay. So we are done with question number, and that was 36. Now we will do question number 37. So for question number 37 also, I have done my homework already that here. These are, and I will explain each and every point that here now. But if you have not yet done that here, so for question number 6, you can pause the video and write it down this. Pause the video and write it down this in a notebook. Okay. Done. Okay. Now just first listen me that here also for question number 37. When I will do the analysis, just listen me. Okay. Now later on at the end of the question, you can pause the video and write it on this as well. Okay. Now come to question number 37 now. From the following balance sheet of H Limited and its subsidiary S Limited drawn up at 31st of March 2021. So what is the date of balance sheet? That is 31st of March 2021. Prepare a consolidated balance sheet as at that having regard to the following. Now they have given us the first of all the balance sheet of holding company and subsidiary company on 31st of March 2021. But in the first para that they mention about the position of reserve and the profit and loss account of S Limited means subsidiary company. And they have mentioned about, let me read it and I will explain. This is the main point, especially the second one that here. So reserve and profit and loss account of S Limited stood at rupees 25,000 and 15,000 respectively on the date of acquisition of its 80% share by holding company on 1st of April 2020. So what is the date of acquisition of shares? 1st of April 2020. What is the date of balance sheet? 31st of March 2021. So the date of acquisition is 1st of April 2020 and the date of balance sheet is 31st of March 2021. In first para, they tell us that here reserve and profit and loss account of S Limited, that is subsidiary company, stood at rupees 25,000. So opening the reserve balance on 1st of April 2020 is 25,000 and profit and loss account balance is how much? 15,000. So 25,000 is the balance that they have here, and this is how much it is that 15,000 here is a P&L balance. So I write it down that here now. Don't write, just listen first. Okay, reserve balance that they have here at the starting 25,000 and the profit and loss account balance that they 15,000. Okay, this is the balance that they're opening. We have not yet come to the balance sheet part. Now this para is very important. Just I'm reading it, but I will explain you in detail. All this working here is related to that para only. I will explain you in detail. Now they say machinery book value rupees 1 lakh and furniture book value rupees 20,000 S Limited were revalued at rupees 1,50,000, 15,000 respectively on 1st of April 2020 for the purpose of fixing the price of its share. Rates of depreciation computed on the basis of the useful life. Machinery 10%, furniture 15%. I will read this para. This para is very important. I will discuss with you in detail. Okay. Now balance sheet that they have given of the holding in the subsidiary company, that here the shareholders fund share capital is 6 lakh and 1 lakh. Okay. Then here reserve and surplus 3 lakh and 1 lakh. Current liability trade payable 1 lakh 57,000. Non-current asset PP that 4 lakh 50,000, 1 lakh 7,000. Other non-current investments 6 lakh and 1 lakh 50,000. Now notes to account. Share capital 6,000 equity shares of rupees 100 each fully paid 6 lakh. 1,000 equity shares of rupees 100 each fully paid 1 lakh. Then reserve and surplus, general reserve 2 lakh 75,000 and here profit and loss account 1 lakh and 25. Then PP here, machinery 3 lakh 90,000, furniture is 1 lakh 50 and 15,000, total is 4 lakh 50 and 1 lakh 7. Other non-current investment, non-current investment that is 4 lakh 40, 1 lakh 50 and shares in subsidiary company. The holding company purchased the shares in subsidiary company, that 800 shares that they've purchased at the rate of rupees 200 for the cost of acquisition is 1 lakh 60. Okay. Now they ask us to prepare balance sheet. Always I told you what is the first thing you have to do, analyze the profit of subsidiary company. So we'll do the same. So how much is the reserve and surplus of the subsidiary company that day? The reserve and surplus of the subsidiary company is how much here? That is here 1 lakh. So the reserve and surplus of subsidiary company is here how much? There is 1 lakh. Now what happened that here now? When I go to this reserve and surplus, notes to account number 2 basically. When I go to this notes to account number 2, this is the position that they have at the end of the year of general reserve that they have here 75,000 and profit and loss account that they have how much? 25,000. They have a balance in general reserve is 75 at the end of the year and the profit and loss account 25. We're talking about the profit of subsidiary company. Now understand this. How much is the reserve balance mentioned in question at the starting of the year? It is 25,000. Now at the end of the year, how much it is? 75. So from 25, it increases to 75. How much at the starting of the year? At the starting of the year, it was 25,000. At the end of the year, how much it is? 75,000. So remember that. What is the date of acquisition? 1st of April 2020 is the date of acquisition. It means this is the balance that they have on these date. It's a pre-acquisition profit that they have made in the past. Okay. Now, after this date, whatever profit they are making, that is going to come post-acquisition. So, okay, this is not at the mid of the year. So whatever the profit that they've made during the year, that is going to come in post-acquisition profit. So the balance that they have at the starting, it was 25 now. It will come in pre. It increased from 25 to 75. So it increased by 50. That will come in post-acquisition profit. Now when it's come to the profit and loss account, at the end of the day, they have a balance of 25. So I will write it down that here now. Starting, they have a 15,000. And at the end of the year, they have 25,000. Okay. So at the starting of the year, they have 15,000 that here now. At the end of the year, they have how much? 25,000 that year. So it increases by how much? 10,000. So when it is increases by 10,000, this 10,000 is going to come obviously in post acquisition, and this 15 is the opening balance, that is on the date of acquisition, this profit that they have made before the acquisition. So this 15 will come in pre, and the post acquisition profit of 10 will come in post. How this 10 comes? 15 is the opening, at the end of the year it was 25, the profit that they have made during this 10,000. That is the main part. This is the main part. So we know that how much is the pre, how much is the post. So when we will make working note number 2 on analysis of profit of subsidiary company, this is how we will write it down. In pre like this, and post this amount will come. You got the point here? Okay. Now what happened now? We will discuss that here. Okay. The pre and post that I will discuss with you there. Okay. Okay. Now what we'll do that here now, this is the point where now we will draw a balance sheet. Okay. Now this para I will discuss with you. Don't worry for these para. So how we solve that here? We draw a balance sheet. So here they have write it down the equity and liabilities, shareholders fund, then share capital. Okay. That is notes stock on number 1, then reserve and surplus, then minority interest, then current liability. There is no non-current liability here. Okay. Then here asset, here non-current asset. Oh, there is no current asset also here. Anyways, how many notes stock on? 4. Share capital. Okay, reserve and surplus, minority interest, and PP. But they have made one more other current asset as well. No problem. But why other current asset is not appearing in sheet? Why it is not coming? 5,90,000. Okay, just give me a minute. Non-current asset should be other non-current. Okay, other non-current asset, that is. Okay, now understand. So now how many notes stock on? How many working notes? 4. First is shareholding pattern. Okay. Second is analysis of profit of subsidiary company. I will discuss with you pre and post, but by in post here, the 2 columns are there: general reserve and profit and loss account. I will discuss with you why 2 columns. Don't worry for that. Okay. Then we have working note number 3, goodwill or capital reserve. Working note number 4, adjusted profit and loss account. But one more thing that I will discuss this point. I told you that there is some adjustment. This para I will read you later on that this para. On that they make a working number. They made a working note number 5th. But I always prefer to go and understand the concept of accounting through the journal entry. That is the basics of accounting is very important. That okay. So I will explain this working number 5th. What is that? I have write it down detail in my notes that I will discuss with you. Okay. Now we prepare all these notes to on and working note. Okay. Now one by one. What I will do that here now? One by one, take a figure. So where this 6 lakh will come share capital, it will come here in 6 lakh will come in share capital, but they have notes stock on number 1. So I will go there. 6,000 equity shares of rupees 100 each. One more thing that here, how many shares we acquire? 800. How many shares subsidiary company has that here? But why? Okay, we acquire it 200. That okay, but the face value is 100 here. So if I say number of shares 1,000, so out of 1,000 we acquire 800. So 80% is the shareholding pattern. Okay. Don't get confused here. The face value is 100, but you acquire at 200. Okay, don't get confused here. Why don't get confused here that here now? Because we purchase at the market price, so you don't have to worry for that. We purchase at what? The market price here. So shares can be purchased at any price that here. Okay, shares can be purchased at any price. We purchase at what? 200. No, it is at the market price we have purchased, obviously. But out of 1,000 shares, how many shares we hold? 800. It means 80% is the shareholding. So you can see that here now, if you go to the working note number 1, shareholding pattern will be 80% and 20%. Okay. Now one by one. Start it from here. We have write it down this share capital. Okay. Now these, I will come to the subsidiaries companies, but here reserve and surplus here 3 lakh. So I will go to this 3 lakh here, note stock on number 2. General reserve 2 lakh. Where it will come? Reserve and surplus. This 1 lakh should also be come in reserve and surplus, but there will be some adjustment. That's why we write it down in working note number 4. Later on, from the working note number 4, the balance will transfer to reserve and surplus only. So go to reserve and surplus. We'll write it down this 2 lakh. So in reserve and surplus, you can see that here this 2 lakh. Okay, what is this 40,000? I will discuss with you later, but 2 lakh. Then here how much it is that here now? This is 1 lakh is the profit and loss account balance. So working note number 4, you can see that here how much we have. We have here the 1 lakh that here now. Okay. Then we have here after this reserve and surplus, we have here. I will come to the share capital reserve and surplus of subsidiary company, but this 1,50,000 and 57,000. Okay, where it will come that here trade payable. So whether they have prepared notes to account on this, no, to trade payable that here we'll write it down in balance sheet that here. Okay, 2,07,000. How we have calculated? 1,50,000 plus that we have 57,000 plus 57,000. How much that is? 2,07,000 total is that. Okay, then we have here is share capital. This share capital, this 80% and the 20% is. How much is the share capital? 80% and what? The 20% here. Okay. Now what we do that share capital, do you remember that now we discuss about it that here now is share capital. These deduct from the cost of investment working note number 3. So we'll go to working note number 3. Just give me one. Okay. We'll go to working note number 3. So this how much is 1 lakh. So you can see that is a 1 lakh. Okay. Working note number 3. Now working note number 3. Okay. Working note number 3. This is so here 1 lakh multiplied by 80%, 80,000. Okay. And what about the minority? That will go to notes to account number 3. So we'll go in notes to account number 3. Okay. 1 lakh multiplied by 20%. That will come how much? 20,000. Then here, after share capital, we have a reserve and surplus of subsidiary company 1 lakh. But this is notes to account. We have already discussed about this analysis part of this reserve and surplus. General reserve have closing balance 75, P&L 25. But I already discussed with you. We just have to take a figure from here. So how much we have in the reserve? Pre 25, post 50. So we can see that the analysis of profit of subsidiary company is working note number 2. So pre here general reserve, okay, pre here 25 and the post is 50. You will say, sir, why in the post do you make a 2-column general reserve P&L? I will tell you. Just have patience for 5 minutes. Okay. Then we have here P&L pre 15, post 10. So P&L pre 15 and post 10. Some of you may ask me, sir, for the post acquisition, you have made a bifurcation between general reserve and P&L account. But for the pre, you didn't make a bifurcation between just general reserve and a P&L. Correct that here. Let me tell you the logic behind that. You always, the pre will be the 1 column only. But in post column, we have to bifurcate when, if there is any post acquisition, you have to see that in the post coming P&L balance is coming in post, yes. But the general reserve balance is coming in post, yes. So we have to make the separate column for the post. Now here, in the previous question, there is no post for the general reserve. That's why we didn't make a separate column in post for the general reserve. Why? Because what happened when the total will come here? Because the pre basically ultimately we deduct from the cost of the investment and minority we give it to minority. But post acquisition profit basically it's a profit which belongs to holding company. We add to the profit of the holding company. So general reserve balance will add to the general reserve balance and P&L account balance will add to the P&L balance. It's a revenue nature profit. So general reserve portion will go to general reserve and P&L balance will go to P&L. So that we have to add it there. What we have to do? We have to add it there. Okay. So that's why we have to bifurcate. When we have to bifurcate in post, if anything is coming in the post is coming general reserve. Yes. Post is coming P&L. Yes. So we have to make a 2 column here. Not for the pre, because pre is the capital nature profit. Ultimately we deduct from the cost of investment to total amount. So there's no need for that. Okay. So that's why we have made 2 separate column in a post column. That is the general reserve and profit and loss account. Okay. Now we have done with it. Okay. Now what we'll do that? Now asset side. So PP notes to account number 3 is notes to account number 3. That is machinery 3 lakhs. Okay. I will discuss one by one. So 3 lakh and 1 lakh 50 is furniture. So I will come to this portion because there is some adjustment on it. So let me keep it as a pending that here because there are certain adjustment of it that here. Okay. Now one by one. Now I will discuss with these adjustment in detail that the para that I have not yet discussed. So machinery I have 3 lakh and the furniture I have 1 lakh 50. Okay, so PP that here now. Furniture we have here 3 lakhs and the machinery that we have 3 lakh and machinery that we have furniture that we have how much is 1 lakh is 50,000 here. Okay. Now what happened after this that we have? What about this 90,000 and 17,000? You will tell me. So write it down there also. No, there's one adjustment on it. So we'll discuss it. Just wait for 5 minutes. Now here is the other non-current investment. Okay, that is 6 lakh and 1 lakh 50. Notes to account number this. So this is not a investment in subsidiary company. So it will come 4 lakh 40 and 1 lakh 50. So 4 lakh 40 and 1 lakh 50. This is notes to account on it. But this is the cost of investment by the holding company and subsidiary company. So it will come as a cost of acquisition in working note number 3. So if you go to the working number 3 that here now, you can see that here now 1,60,000. Okay. Now one very strong adjustment that we are going to discuss it now. Now listen that here now. How much balance we are very interesting. Okay, go to the basics of accounting. It will be easy for you to understand that here. How much is the balance that we have? Closing balance of machinery 90 and the furniture 17. So I'll discuss it one by one because there are adjustments. Let me discuss with the machinery first that here. How much closing balance we have for machinery? Let's talk on the machinery only 90. So we have a balance of 90. See here carefully. Okay, 90. Now they tell me that here now. Read this para. Machinery whose book value was rupees 1 lakh and furniture whose book value was 20,000. We'll discuss about the furniture later on. We are revalued at rupees 1 lakh 50 and 15,000 respectively. So for the machinery, they're talking about the book value was 1 lakh. They want to revalue at 1 lakh 50,000, but on which date? On 1st of April 2020. The point that I've highlighted with the red color, just focus on that. So machinery at the starting of the year, the book value, they say it was 1 lakh, but they want to do the revaluation, but not today, not on 31st of March 2021. They say it is going to be revalued in a past date, that is 1st of April 2020. Now understand it. And they say the rate of depreciation on machinery is 10%. Now understand this. Listen carefully. This is the main part. I say that here this figure is given, which is given in balance sheet. Do you agree? Yes. This figure that they have given in what? This figure they have given in balance sheet. Okay. Now what happened is that now I say it's a 90,000. Okay, sorry. I say this is a 90,000. That okay, just don't make it confusing for you. Okay, this is 90,000. Okay. Now they say the figure that they have book value at the starting of the year, how much it was. The book value that they were at the starting of the year, it was how much here? 1 lakh. So the book value that they were starting of the year is 1 lakh. Okay, at the end of the year. And logically it is correct that here the rate of depreciation is also 10%. So if you see that this figure is given in the balance sheet, they mention in the adjustment that the value at the starting of the year, it was 1 lakh. So 1 lakh, 10%, the depreciation 10,000. This is the closing figure is correct. Now listen. They want to do the revaluation of it. When they want to do the revaluation at the starting of the year, at what value? 1 lakh 50. So it was 1 lakh. They want to do the revaluation 1 lakh 50. It means they want to increase the value of PP by 50,000. By what value they want to increase the value? By 50,000. So it was 1 lakh. They want to, it was 1 lakh. They want to increase it to how much here? 1 lakh 50. So they want to increase it by 50,000. So increase. Now go to accounting, please. Huh? I will not tell you by add or less. I will come to that, but more important, working note is given in add or less. Go to the root of accounting. Okay, debit credit. So it is going to increase from 1 lakh to 1 lakh 50. What should be the entry here? PP account will be debited by here 50,000. PP account will be debited here by 50,000. And revaluation gain, you can say revaluation reserve will be credited by 50,000. So whenever we do the revaluation AS10, this will go into revaluation reserve column. So because we are increasing by 50, so increasing asset debit. So PP account debited by 50,000, revaluation reserve credited by 50. Correct. What is pre and post? I will come to it later on. So if it is going to revalue at the starting of the year, so depreciation here should not be 10,000. It should be 15,000. 10% of 1 lakh 50, it is going to become 15,000. Correct. And the closing value should be 1 lakh 35. Do you agree? Now one by one. So what happened here? We are going to increase the asset by 50,000. So I will come to the depreciation part. So PP account debit to revaluation reserve. So I am going to increase the value by 50,000. So 50,000 PP account will be debited. So this is the value which is appearing currently, and I am to debit it again by the 50,000. Okay. So what is the closing balance? I will come to that. Don't worry. Okay, 50,000. But where this revaluation reserve will go, because we are talking about the subsidiaries company. So if you do the revaluation reserve, it's a reserve and surplus. So it should go to working note number 2, analysis of profit of subsidiary company. Correct? It will go to the analysis of profit of subsidiary company. But where? Pre or post? Now apply the logic. What is the date of acquisition? The date of acquisition was 1st of April only. So we are doing the revaluation here only, 1st of April only. But it's an old asset that the value increased in the past, and this is a position on this date that here. So it should come the pre-acquisition portion. So you will say, no, sir, we acquire the share on 1st of April 2020. We are doing the revaluation also on 1st of April. So it should be post. No, it's an asset, past asset. Okay, we purchased in past. The value increased from 1 lakh to 1 lakh 50 in the past. This is the position that they want this date that here. So it will come in the pre-acquisition. Okay, point number 1. So if you go to this here, analysis of profit of subsidiary company, wait, you can see that here pre-acquisition 50,000. Okay, then I come here to the depreciation part. We charge depreciation actually 10, but revalued here on these dates, so it should depreciation should be charged how much? 15,000. So we have a short depreciation we have charged. By how much? By 5,000. So we have to charge the depreciation here. So what entry we will pass here? Depreciation account should be debited by 5,000 and machinery account will be credited by 5,000. So what entry we are going to pass here? Depreciation account debit 5,000, machinery account will be credited by 5,000. You got the point here? So this is the entry that we should pass. Depreciation account debit 5,000, machinery credit, because we have passed the entry for 10,000 only, but depreciation should be 15, because if you calculate 10% of 1,50,000, that is going to become 15,000. So we have to charge the depreciation 5,000. The entry will be depreciation account will be debited and the machinery will be credited. So I will come to this machinery part, but depreciation account will be where this depreciation will come, pre or post? It will come in post, because date of acquisition is 1st of April. We are charging depreciation after the date of acquisition here for the during the current year, okay, during this year. So this will come in post. So you can see that here now is the 5,000 is a depreciation. Okay, profit will go down expense. That's a negative figure in P&L. Okay, P&L profit will go down. Now, how much is the balance will be here? You can do in calci 90,000 here, plus debited by 50, so plus 50 minus 5, that will come how much? 1,35,000, or you can say that 1,50,000 minus 15,000, 1,35,000. It will appear in balance sheet. Now go to the balance sheet now. Here. You can see that here. If you go to the balance sheet that here, this is how we have to think the accounting subject that here now. If you go to the balance sheet that here now, you will see that where is the balance sheet? P. Okay, you can see that here 1,30,000. Okay, now again we'll discuss about these about the furniture as well. Furniture that they have given the reverse calculation, to exact reverse of it, no problem. How much is the furniture? 17,000. So you can see that here now I made it for furniture as well. So I have a closing balance. How much closing balance I have here? 17,000. Okay. Now what happened that here now? They mention us in the question that in the first para. Okay. Now they tell us that here in first para that here. Okay. Is that question? Okay. So they tell us that here now furniture book value was rupees how much here? 20,000. How much is the value of the furniture book value? 20,000. And at the starting, and they want to revalue 15. Okay, so and the rate of depreciation is 15% on 1st of April 2020 only. So they say here the closing is actually appearing in balance sheet 17. This opening was 20. Logically it is correct. 20 minus 15%. If we do that, will come 3,000. Correct. But they want to do the revaluation here from 20 to 15. So they are not increasing value. Here they are increasing the value. Here they are decreasing the value. So decrease in asset should be credited. So decrease in asset should be credited. So what entry we are going to pass? Revaluation loss account will be debited, these 5,000, and furniture account will be credited. So what we are going to pass entry here? Revaluation loss account will be debited here by 5,000 and furniture account will be credited by how much here? The 5,000. Okay, decrease in asset. Now where this 5,000 will come? Will reduce the value. Okay, just this is the value which is appearing. We credited here. But where this 5,000 will go that here now? It will go to pre-acquisition, because we are doing the revaluation. It's a past asset. Okay, the 5,000, but loss it is that is. So you can see that here now in a working note number 2, analysis of profit of subsidiary company. You can see that here now is the 5,000 is a negative figure. Simple. Okay. Now how much depreciation we have charged? We have charged 3,000. How much it should be charged? 2,250. So we have charged 3,000. It should be charged 2,250. Why? If you take the 15% of 15,000, that is 2,250. Okay. So how much should we charge? 2,250. We charge additional depreciation that day. How much additional depreciation we have charged? We have charged 750 additional depreciation. Now understand, what entry do we pass for the depreciation? We pass entry depreciation account debit to asset account. Now this is actual entry we pass for depreciation. Now actually we have to reverse it, because we have additional depreciation we have charged there. So when I reverse the entry, it should be asset account debit to depreciation. We are reversing the entry because additional depreciation we have charged. So we have to cancel it. So whenever we do the cancellation, we just have to reverse it. So originally we charge entry for depreciation account debit to asset account. Now we are reversing it, asset account debit to depreciation account that here. Okay. So basically if you depreciate credit it, the profit will increase that here. Okay. It's a post because the depreciation is during the year. So you will see that it's a positive figure that they have written 750, because we are cancelling depreciation, we are cancelling expense, the profit will increase that. If you understand it, you are super talented. Okay. Now, done question. Okay. So if you do the total that here now, So I always prefer to learn the accounting, and I always teach to my student, go with the debit and credit, where you will actually, this is the right way to understanding the accounting that here now. Not these, the add or less add, so it's okay that here now. But you will understand the accounting from this debit and credit only. So here is the balance appearing is 17,000. You're crediting it, so minus asset as a debit balance, 17 minus 5, 12 plus 7, you debit it. The asset increase in asset should be debited. That is coming 12,750. If you, or you can see that 15,000 minus 15%. So this figure will appear in what? This figure will appear in balance sheet. That is 12,750. You got the point here now. So here you can see that here now, if you go to this here balance sheet, that here now this 12,750 done. So now we'll close down notes to account one, working note 1 2 1 by 1. First, second. Now understand. Now this is a pre is coming how much? 85,000. Sorry, 80% and 20%. What we do for these 80% that here now is 80%. What we'll do, the deduct from the working note number 3. So we'll go to working note number 3. We'll deduct here. How much it is coming? 80%, that is 68, and this 17. So this is where it will come. 68 will deduct here. Okay. Then here, what about the these 17,000? Here it will go notes to account number 3. So we will go notes to account number 3. Okay, we'll go to notes to account number 3. You can see that here now 17,000. Okay, then here is pre-acquisition profit. Okay, dividend. Okay. Oh, sorry, I was reading from here, but this pre-acquisition. Sorry, this post here now. Okay. Now add to the profit, this we were discussing. Add to the profit of the holding company. Okay, understand that. We'll do the same that here, but beta, this post acquisition profit, it is that here. This is a post acquisition profit that here now. But what happened here now? This general reserve, first let me talk. General reserve will go to general reserve only. So it will go in reserve and surplus. Where it will go? Reserve and surplus 40,000. So you can see that here now. I will add. You can see that here now reserve and surplus 40,000. See that? Okay. Now here it will go to non-controlling interest. Whatever belongs to non-control, it will go to non-controlling. They have a note stock on number 3. So note stock on number 3, this is 10,000 there. This P&L will go to P&L. So it should go to general reserve and surplus, sorry. But we have make a note stock on working note on it, working note number 4. So you can see that working number 4, 4,600, 4,600, that is. Okay. Then whatever belongs to non-controlling, that will go to non-controlling interest. How important this table is that here. If we go to the study material, you will get confused from where the figures are coming. If this is the main working note that we have. Okay. So 1,150, it will go to 1,150 minority interest total. You will write it down here. Okay. So done that here. Now we have done this part. Okay. Now working number 3, it is coming 1,60,000, 1,40,000. Finally goodwill come. Positive figure. So where goodwill come in? Balance sheet. So if you go to the balance sheet, you will see that here on asset side that is coming how much here? 12,000 here. Okay. Then here, this is a balance that they have coming 1,04,600. 1,04,600 is the balancing for that is coming here. Okay. So where it will go? It will go reserve and surplus. Okay. 1,04,600. So this 1,04,600 done. Now note stock on 1 by 1. First 6 lakh. 6 lakh, second 6 lakh, 3,44,600, 3,44,600, 48,150, 48,150. Then we have here PP's total is 597,750, 597,750. It is coming 5,90,000. Here it is coming 5,90,000. Done. Okay, this is the total of what? The balance sheet. So this is how the question comes in examination. You can do it. We will cover the how to prepare the consolidated P&L, the one more concept, uniform accounting policy. I will cover every point that here. But you should know the approach that here. The analysis part is important. This is how we prepare. Okay. Now we'll go to next question. That is this is question number now 38. Now come to question number 38. A Limited acquired 1,600 ordinary shares of rupees 100 each of B Limited 1st of July 2021. So what is the date of acquisition? 1st of July 21. How many shares acquired by the holding company? 1,600. On 31st of December 2021, the balance sheet of the two companies were as given below. So they have given us the balance sheet 31st of December 2021. So now understand the fifth one is that. Okay. Now is that the year start, the balance sheet is of 31st of December 2021 that now. Year start on 1st of January 21. What is the date of acquisition? Date of acquisition is 1st of July 2021. This is the date of acquisition. Okay. Then they say that here now they have given the balance sheet of both the companies that here now is the equity and liabilities, shareholders fund, share capital, note 1, 5 lakh, 2 lakh, reserve and surplus, note 2, 2 lakh 97 200, 1 lakh 82,000. Current liabilities, trade payable, 47,100, 17,400, short term borrowing, note 3, 80,000 dash. Then we have non-current asset here is the PP, note 4, 3 lakh 90,000, 3 lakh 15,000. Then here B, non-current investment, note 4, note 5, sorry, 3 lakh 40,000. Then we have current asset inventories, 1 lakh 20,000, 36,400, trade receivable, 59,800, 40,000, cash and cash equivalent, 14,500 and 8,000. Now here, notes to account, share capital, that is the 5,000 shares of rupees 100 is fully paid up, 5 lakh, 2,000 shares of rupees 100 is fully paid up, 2 lakh. Reserve and surplus, general reserve 2 lakh 40, 1 lakh, profit and loss account 57,200 and 82,000. Short term borrowing, bank overdraft 80,000, property, plant and equipment, land and building 1 lakh 50,000, 1 lakh 80,000, plant and machinery 2 lakh 40,000, 1 lakh 35,000. Then your non-current investment, that is investment in B limited at cost 3 lakh 40,000. Okay, 3 lakh 40,000. Then here we have cash and cash equivalent, cash 14,500 and 8,000. Now here, this is interesting. Now the profit and loss account of B limit shows a credit balance of rupees 30,000 on 1st of January 2021, out of which a dividend of 10% was paid on 1st of August 2021. Now understand this. They are saying that, the balance of a, we are analyzing the profit, that you can see that they have given us the general reserve that here now and P&L account. So we are discussing about P&L account that here. They have a balance here at the starting. They have a balance. How much at the starting of the year? How much balance that they have? 30,000. How much balance that they have a starting that they have a balance of 30,000? How much balance that they have at the end of the year that is coming? How much? 82,000. So they have here at the starting that here now is the 30,000 that they have at the starting, and they have at the end how much that they have? 82,000 that year. So the profit, that P&L balance that they have 30 and at then they have 82. But they are saying that here now on 1st of January, out of which 10% dividend that paid by the subsidiary company in 1st of August. So how much is the dividend, that how much is the capital that they have subsidiary company? 2 lakh. 10% of 2 lakh, that is going to come 20,000. So they paid a dividend of these 30,000 from these 30,000. The 2 lakh is the amount of capital that they have, multiplied by 10%. So that is coming 20,000. So opening was 3 lakh. They paid a dividend from these 20. So the balance is 10,000. The balance is 10,000. Opening balance, I mean, say now left 10,000. At the end, it is 82. So it increased not from 30 to 82. Basically, it increased from 10 to 82 because out of that 30, they paid a dividend of 20,000. So how much balance that they left? 10,000 from the opening, and it increases from 10,000 to 82,000. So it increases by how much? It increases by 72,000. So when it is increases by 72,000, that is what is the date of acquisition? That is at the mid of the year. This is the profit that they have during the year. So it will equally distribute between the pre and post because they acquire the shares in the mid of the company. This 72,000 will be distributed in the ratio of 6:6. That is 36,000, 36,000. So this 10,000 will come in which column? This 10,000 will come in a pre column that year. Okay, because obviously the opening balance, but these that the profit that they have made during the year, which is how much is 72. So 36 will come here, 36 will come here because in the mid of the year they have done the acquisition. Okay, done analysis part. Okay, but what happened here, events come to, they have not mentioned anything. I will read the remaining point. This point is also very important. So new to you. I will discuss with you in detail that here, this point, the point I am highlighting. I will discuss with you in detail later on. Okay, don't even read it. Okay, now let's start here. They have not mentioned anything about the opening balance of general reserve. So we don't know because the closing balance is 1 lakh. So we don't know that here. The closing is 1 lakh that we know, but whether it is addition during the year or it was the opening, we don't know that here. So if it was the opening, it will come in pre. So we don't know that yet. So we assume that basically this 1 lakh was the opening, was also the 1 lakh. Nothing is mentioned in the question. The same assumption taken by the ICAI. This is what I am taking that here now. This 1 lakh is the closing balance. We assume that at the starting of the, it was also the same. So I have write down here general reserve, not mention that is. So assume the pre only. So this 1 lakh is the pre only. Okay. Now, okay, whether you write, if you want, I can share this PDF also. This, if you want, I can share in the Telegram channel. Okay, this PDF, you can write it down, but I will also share there. Okay, don't worry. Okay. Now what happened here, this general reserve, which is not mentioned the opening, but I will share there, don't worry, okay? Now, assume it is a assume that it's a pre. So we have done the analysis part here, okay? Now these points, the new adjustment, the point that I highlighted here with the green color, I will discuss with you later. Now this is the plant and machinery which stood rupees 1,50,000 on 1st of January was considered as worth of rupees 1,80,000 on 1st of January. Remember the date. The opening balance, which was on 1st of January 2021, the book value was rupees 1,50,000, was considered worth 1,80,000 on 1st of July. So they are not doing the revaluation, they're starting not at the end, they're doing it in the mid of the year. Okay. But the book value is not 1,50,000, book value is not at the mid. The book value is of the opening date. And they're doing the revaluation in the mid. And the balance sheet figure is a different thing. So 3 dates, opening, mid, and closing date. So opening book value is 1,50,000. They want to do the revaluation at the mid, and the revalued amount is 1,80,000. I tell you how to do that. Don't worry. Okay. This figure is to be considered while consolidating the balance sheet. The rate of depreciation of plant and machinery is 10%. Okay. The point that I've highlighted with green color I will discuss with you. Don't worry. But let's do the question. That will start the question. If you want, I can discuss with you this point as well. You already know about it, okay? But we are doing the revaluation in the mid of the year. I will explain that, you know. So what is the share? I will discuss with you analysis part, this part, okay? This part I will discuss with you. Don't worry for that, okay? Then the figure will write it down in balance sheet. And the green point that I've highlighted, this is the point. I will discuss this point as well with you, okay? Now, so we have done the analysis part of analysis of profit of subsidiary company, which is the main part here, okay? Now we'll write it down one by one. But how much shares we hold? How much shares we hold? Yes, 1,600. How many total number of shares? 2,000. So out of 2,000, we hold 1,600. It means 80%. So write down in shareholding pattern that here now. That is here working. Oh, they have prepared so many notes to account. It's okay. But okay, there's no need to prepare that much, but it's okay. Okay, now here notes to working shareholding pattern, analysis of profit of shareholding pattern. You can see 1,600, 400 shares, 80%, 20, total is 100%. Now we'll write it down one by one here. Okay, let's go here one by one here. So these figure, remember that now these are danger zone that here now. Why is danger zone that here now? You know it. Okay. Now one by one. Share capital, where it will come? Note stock on number 1 first. We have to go 5 lakh. So where it will come? It will come in share capital. That is how much it is coming that here now? 5 lakh that here. Okay. Now 5,000 shares of rupees 100 is fully paid up. That is 5 lakh. Okay. So here share capital that here now, which is coming how much? Note stock on number 5 lakh. We'll write it down. Share capital. Okay. Then we have here then we have here share capital. Then here we have reserve and surplus. Note stock on number 2. So this is here 2,40,000 general reserve. It will go in reserve and surplus. It will go in working note number 4, one by one. So 2,40,000 reserve and surplus. 2,40,000 reserve and surplus. Okay. Then it will go 57,200 in working note number 4. So 57,200. You know that here. I in my regular batch also, so many questions I solved there. I have made these way. Every question with ICI, new questions come in examination. I solved in my pattern that, and I in the same fashion that we solve the regular batch, all the homework question I change in this fashion. I'm not saying the answer will be same, but this flow should be this flow. Then you will be able to solve the question quickly. That okay. So 57,200. Okay. Then again we will go to the balance sheet that here now. We have here, after that we have here is we have done the, okay, now I will analyze their reserve and surplus and all that, this danger zone. Okay, we'll do the analysis that here, don't worry. I will come to that here. Okay, analysis of share capital, reserve and surplus subsidiary company. Trade payable 47,100, 17,400. So whether they have prepared a note stock on it? Yes, 47,100 and 17,400. Okay, then we have here. Then we have short-term borrowing, note stock on number 3, 80,000. I will go to note stock on the bank overdraft. We have prepared note stock on number 3 that here. Okay. That is a short-term borrowing. How much it is? 80,000 that here now. Okay. Then we have property, plant and equipment, note stock on number 4, 3,90,000, 3,15,000. Let's go note stock on number. So land and building 1,50,000 and 2,40,000. I will come to subsidiary 1,50,000 and 2,40,000. So 1,50,000. Wait, 1 lakh. What did you say? Just give me 1,50,000 that here now, and 2,40,000 is the plant and machinery. Land and building is a plant and machinery. Oh, why they have mentioned? Okay. Plant and machine. Just give me a minute. That now here. But that is for the subsidiary company only, na? Yes. Okay, no problem. Let me write it down. Plant and machinery. How much it is that they have here? The subsidiary company will do the analysis. This is coming 2,40,000. No problem. Let me write it down inner column. Okay, then we'll work in number 5th. We'll do the because there's some adjustment in the here land and building. It will say here the land and building is same that here now, but there is no adjustment. Is 1,80,000. So you can see this 1,80,000. Okay. Now about these balance, like in the previous question that we have done the some adjustment. Like in the previous question we have done certain adjustment on this 130. But here also same here it will come 135. We will discuss about it. Okay. Then we have here. Now we have a non-current investment that here 3,40,000. So note stock on number 3,40,000. That is the investment by the holding company, subsidiary company 3,40,000. So working on number 3. Once you understand the flow, then it is easy. 3,40,000. Okay. Then we have here is the inventory 1,20,000, 36,400. So 1,40,000. Sorry, 1,20,000 and 36,400. Okay. Then we have here is 59,800, 40,000 trade receivable. So 59,800 and trade receivable 40,000. Then we have cash and cash equivalent. Note stock on number 6 that here 14,500 and 8,000. 14,500 and 8,000. Done. Okay, we have written down all the items here of balance sheet that here. Okay, now here understand. No, these two still are pending that here. Share capital 2 lakh. What we do? Note stock on number 1. What we do for this 2 lakh? To remember this here 2 lakh. That is deduct from the cost of investment and note stock on number 3. So that is 2 lakh, 80% was the shareholding, 80-20. So note stock on number 3, I will say that here now is 2 lakh multiplied by 80%, that is 1,60,000. And note stock on number 3. So note stock on number 3, if you go that here now is this amount 2 lakh multiplied by 20%, that is coming how much here? Is the 40,000. You got the point here? Okay. Then we have here. Okay, now here reserve and surplus that here now. Okay, now this we have to write reserve and surplus is here. They have mentioned is 1,82,000. Note stock on number 2. So we'll go to note stock on number 2. General reserve that here. So we have done the analysis part here. General reserve. Nothing is mentioned about the opening. So we assume the closing. What is the closing? The same is the opening. So if you go to the here and here note stock on this working note number 2. So you can see this is a pre column post. Okay, now you can see that here now general reserve will be the in a pre column 1 lakh. Okay, we have done the analysis of profit and loss account. Opening was 30 minus 20, 10 will come in pre. So you can see that here 30 minus 20, 10 will come in pre. And then here this is the post will come 36 and pre and post 36 will come here. So here 36 and 36 will come here. You got the point here? Okay. Now we're done with all the adjustment that here. Okay, now whether the liability side also cover that here. Okay, now I will come to this highlighted point later on at the end that I will discuss with you. Okay, this is the plant and machinery stood at rupees 1,15,000 1st of January at the starting of the year. Okay, and was considered as worth of rupees 1,18,000 1st of July. Rate of depreciation is 10%. Now understand this point here. So for the plant and machinery, which is appearing in balance sheet at the end of the year is 1,35,000. They said the starting of the year it was 1,15,000, which is correct. That is the rate of depreciation 15%, 10%. If you take a 10% of 1,50,000, that will come 15,000 only. So 1,50,000 minus 15,000, that will come here 1,35,000 here. Okay. Now understand. They want to do the revaluation when? In the mid of the year. Here they want to do the revaluation on 1st of July. But what is the book value? We can say that here it is coming from 1,50,000 is the opening. The closing is 1,35,000. It means the depreciation that they've charged during this 15,000 that they've already charged for the whole year. Then how much will be for the 6 months? Because we are doing the revaluation here. I want to know the book value on 1st of July. The total depreciation for the whole year was total depreciation for the whole year it was 15,000. So here it will come 7,500 for 6 months. Here 7,500. Okay, equally that they've distributed. They've already charged 15,000. 6 months if you take 7,500, 7,500. Now the day they want to do the revaluation, the book value was 140,500. They want to do the revaluation 1,80,000. It means they want to increase the value from 140,500 to 1,80,000. So they want to increase the value by 37,500. Correct? It was 140 to 500. They want to increase the value from 140 to 500 to 1,80,000. They want to increase the value by 37,500. Okay. So what should be the entry? Increase in assets. So plant and machinery account will be debited. Revaluation gain will be credited. Okay. Where this revaluation gain will come? In pre. They have done this is date of acquisition. This is old asset. So they want to do the revaluation here. So value increase from 140 to 500 to 180 here only. But this is, sorry, here we are doing a revaluation. But asset is an old asset. So the value was increasing in the past also. That not today here we want to do the revaluation. So it will come in the pre column. So you can see that here now. If you go to the working note number 2, that here it will come here pre column. How much is the value? Okay, 37,500. Yes, you can see that 37,500. Okay. Now, how much depreciation we have charged for these 6 months? 7,500. But if you calculate it for the 6 months, 1,80,000. I have calculated 1,80,000 multiply by 10%, multiply by 6 by 12. So depreciation should be here for these 6 months. It should be 9,000. But we have charged 7,500. So we have short depreciation we have charged. We have to charge now remaining 1,000. Difference is coming 1,500 here. So entry for the depreciation account will be debited. 1,000 depreciation account will be debited by 1,500, and plant and machinery account will be credited by 1,500. Okay, this entry that they should pass here. The depreciation account debit by 1,500, plant and machinery will be credited by 1,500. Where this will come post, because we have acquired the shares here and we are charging depreciation for these period. It will come in post. So you can see that here in a post column that here now this 1,500 that here. Okay. Now, if you see the value, it is appearing in the balance sheet 1,35,000 plus 37,500 minus 1,500. It will come 1,71,000. 1,71,000 it will appear. So if you go to the balance sheet that here now 1,71,000. 1,71,000 it should appear. It will appear at 1,71,000. You got the point here? Okay. Now that's why they have calculated this 4,11,000. Done. Okay. The one point, the additional point, a new point that I want to discuss with you that here now. Let me discuss it from the repeats that here. Okay. So we have discussed it, adjustment first point. Revaluation asset. I already discussed the revaluation of asset that here. So the PP account will be debited, revaluation reserve will be credited. If it lost, the revaluation reserve will be debited, PP will be credited. Okay. Adjustment of depreciation already discussed with you. Depreciation account debit to PP. If additional depreciation that they have charged, we have to cancel it. PP account debit to depreciation. Okay. Now elevation unrealized not yet come. This is not yet come. For the fifth point I am discussing with you. Okay. Now what happened here? They say understand the one concept that obviously when the subsidiary company declares the dividend that year, okay, this also come in AS13 also that year. But where I'm to say where there is no subsidiary companies that year now. Okay, we'll discuss it that year now later on that year in AS13. But focus here what the concept of the holding in the subsidiary company. So when subsidiary company declares the dividend that year, okay, when subsidiary company declares the dividend that now. So obviously holding company holds the shares that in our example, in the question that we are solving, holding company holds how much shares? 80%. So when the holding company holds 80%, so he is going to receive the whatever amount of dividend declared by the subsidiary company. Holding company will get 80%, correct? Yes. But from where the subsidiary company is giving the dividend? If they are giving the dividend out of the pre-acquisition profit, it means the date we acquire the shares. If they are giving the dividend before that, whatever the profit that they have made, from that profit if they are giving them, so that they say out of the pre-acquisition profit if they are giving the dividend that year. So holding company, we are talking the dividend, how the holding company is going to pass the entry. So they will pass entry bank account debit to investment account. So if they are giving the dividend out of pre-acquisition profit, we will not credit to dividend account, we will credit to investment account. But if they are giving the dividend out of post-acquisition profit, so yes, say entry should be bank account debit to dividend account, or P&L account will be credited there. Okay, so this is the correct treatment that here. But ICA certain times rarely they say that here the correct treatment they have been done that here. Now, if they will give the wrong treatment, we have to do the rectification. It is mentioned in repeat. Just listen that here now. Now read this para carefully. What they are mentioning that here now. What they are mentioning that here now. They say that here A Limited that here credited the dividend received to his P&L account. Now read this first. The profit and loss account of B Limited, means subsidiary company, shows the credit balance of rupees 30,000 on 1st of January 2021, out of which dividend of 10% was paid on 1st of August. But from which profit? 1st of January 2021. The date of acquisition is on 1st of July. So they are paying on 1st of August, that's okay that day. But from which profit they are giving? From the opening profit, that is the 1st January 2020, from the opening profit they are giving. So basically they paid the dividend here. They paid the dividend here, no problem. But they're giving out of this profit. We have written this here, pre-acquisition profit that they are giving. So the correct treatment here should be that when the holding company pass the entry, they should pass the entry bank account debit to investment account. This is the correct entry that they should pass. Okay, let me write it down. So correct entry, bank account debit to investment account. This is the correct entry they should pass. They have declared the dividend of how much here? Is 20,000 and we hold 80%. So 20,000 multiplied by 80%, that is 16,000. So correct treatment is that here now is that this is 16,000 that they have. Okay. But what they have done that here now, if you read the question that they said, they have credited the dividend received, it's credited to P&L account. They have credited to P&L account by the holding company limited. That they have pass entry, bank account debit 16,000. To profit and loss account 16,000. It's the wrong entry that they have. So correct entry is that here, bank account debit to investment account. Wrong entry, this is what they have. Because it's the pre-acquisition profit. They have to credit to investment, not to P&L. So we have to pass a rectified entry. They have debit, bank should be debited and they have debited the bank, so no problem. Investment should be credited, but they have not credited to investment, so investment should be credited here. 16,000. And they have credited to P&L, it should not be credited incorrectly there. So to cancel it that way, we have to debit them. Something which we have wrongly credited to, so we have to debit them to cancel. So rectified entry will be P&L account debit to, this is the favorite ICI. They don't ask you this and this. They say they have incorrect treatment given by the holding company, so we have to rectify. This is a rectified entry. Read it. Note sometime it will be mentioned in the question that the dividend received by the holding company from the subsidiary companies out of the pre-acquisition profit, but wrongly credited to the profit and loss account. In that case, you have to pass a rectification entry. P&L account debit to investment. So these P&L account, who has okay, first of all, now one more thing. Where this P&L account will go, you will say no, that is working note number 2, analysis of profit of subsidiary company. No, not analysis of profit of subsidiary company. The reason is that this P&L account is not a subsidiary company. Who had done the mistake? Holding company. Working note number 2, analysis of profit of subsidiary company. Subsidiaries company's profit we are analyzing. Holding company profit is working note number 4. Okay, so don't do the mistake. The working number 4 will be debited here and investment account will be credited here. You can see the P&L account debit, investment account credit. So P&L account of the holding company, that is working number 4. If P&L account of subsidiary company, then that is working number 2. So you will see that here now in working note number 4 that here. You will see that here in working note number 4 that here now is debited by the 16,000. And investment account should be credited. So you can see that in working number 3, reduce the cost of investment. The investment was, if you want to see 3,40,000 was opening, you have to credit by 16,000, it will come 3,24,000. That's why it is less dividend out of pre-acquisition profit effect that here. Okay, so this is 3,24,000. Okay, not done. We have to close down all working note first. So working number 1, shareholding pattern 2. So how much is coming that day? Pre is 183,500, post is 34,500 that year. Okay. Now what happened that here now is the minority will go to minority that here. Pre or post, it doesn't matter. So it will go to notes to account number 3. Now 36,700 and 6,900. So you can see notes to account number 3, 36,700, 6,900. Okay. Then here it will go to the pre-acquisition. Now you should know that. I'm not going to repeat this again. You should know that. It will come in working note number 3. Deduct from working number 3, 146,800. Okay. Now this will go to post-acquisition working note number 4, 27,600. Done. Now come to working number 4. The total cost of investment net is 3,24,000. This is the less this 3,06,800. Positive figure is coming. So this is what? Goodwill. It will appear in balance sheet 17,200. So if you go to the balance sheet, 17,200. Okay. Then we have here working note number 4. The balance is coming 68,800. Reserve and surplus. Notes to account number 2. Okay. Go to notes to account number 2. Write down 68,800 that here now. 68 one by one. Okay. Now this all notes to account. Write it down in balance sheet. 5 lakh. Second, 3,08,800. 3,08,000. Third, 83,600. 83,600. Fourth, 64,500. 64,500. Fifth, 80,000. 80,000. Now six is that here 7,41,000. 7,41,000. Then here intangible 17,200. 17,200. Then this is inventories 1,56,400. 1,56,400. Then we have a 99,800 that here, 99,800 that here, 22,500, 22,500. You got the point here? See how easy it is. That it needs a practice, no doubt about it. You should know the approach better. I tried my best to cover all kind of adjustment that here. Okay. So, but obviously at the end, I'm going to say I will discuss with if any point is pending that here. Now we'll discuss about the consolidated P&L account in some uniform accounting process. There is one more concept. But before I come to 7 and 8 point, that branch is obviously branch. The next session is on the branch only. So many people are sending me message to take the session on the branch. I will discuss that here. Okay. But there's few points that I will discuss with you: consolidated P&L and a miscellaneous uniform accounting policy concept. But let me go through again that here now. If any point left, then we'll discuss that. Okay. There's no need. I'm to say what is holding. You already know that. No need to read it. Holding, subsidiary, group, company, minority, that here. Okay. No need to read it that here. Difference between wholly owned subsidiary means 100% shares held by the holding company. Partly owned means not 100%. Like in our example, it is 75. That's a partly owned. Advantages of consolidated financial. No need to read it that here. Now the component consolidated balance sheet, P&L and notes account. Okay. The balance sheet we have discussed that here. This is how we prepare that here. Okay. You know how many notes account mandatory you have to prepare? 4. Share capital, reserve and surplus, minority, and one more is on the PP that here. Okay. Now shareholding pattern, you know better that shareholding pattern is the shareholding pattern. Now analysis part. General reserve that here pre and post. But remember, if any general reserve adding or addition or subtraction happening in the post acquisition part, so we make a separate column as general reserve, because general reserve total will go in general reserve, P&L total will go in P&L. P&L capital reserve pre-acquisition, revaluation gain, short depreciation, revaluation loss, excess. Stock is the 1 point not yet come. It will come. Let me explain. It will come in addition. I will discuss with you. Okay. Now calculation of goodwill or capital reserve. Cost of acquisition. If any dividend out of pre-acquisition profit deduct, this balance will come here. Then deduct from share capital pre-acquisition profit. Then I discuss with you all working number 4, opening balance that it profit during the year. If there is any rectification that we have done here, now sharing the subsidiaries company's profit post acquisition. This stock reserve point will come. I will discuss with you. Don't worry. Adjustment that here now. First I have discussed with you. Second I have discussed with you. Okay. Now let's discuss this. What is this? Elimination of unrealized profit concept that here. Okay. 4th, 5th I already discussed with you in the 7th, 8th. Okay. Now understand this point. What is this here? Elimination of unrealized profit. What happened here? Now it might happen now. Holding company. Okay. Goods sold by holding company to subsidiary company. Let me write HNS. Okay. Listen carefully bit. Okay. Now what happens? Suppose holding company sold goods to subsidiary company. Nothing wrong in that. If subsidiary company that here sold these goods to customer, if they sold these goods to customer, then there is no problem. But it might be happen the goods that they have sold by the goods which is sold by the holding company to subsidiary company, some might be in stock. It might be happen some that they have sold to customer, or some might be in stock that year. So if they have, now understand the logic here. When I say I'm holding company, but you are subsidiary company. Okay. I sold goods to you. If you have sold it to the outsider, then there is no problem. If you have not yet sold to the outsider, or some stock still in with you that here. So what happened in individual financial statement, there is no problem. But when we prepare consolidated balance sheet, there is a problem there, because what happened when I merge the balance sheet of holding and subsidiary company, some goods sold by me to you, which is in your stock that year, So when I prepare consolidated balance sheet, this stock will also come in the consolidated balance sheet. But these stocks sold by me to you, there is the profit component in it that year. So in my balance sheet, in consolidated balance sheet, stock will be is overvalued. The stock is overvalued that day. So we have to reduce the cost of the stock. The reason is it is sold by the holding company to the subsidiary company. Okay. So we have to reduce the value of the stock. It is overvalued because it is same balance sheet. Now we are clubbing. We are preparing consolidated balance sheet. So when I say that we are preparing consolidated balance sheet that year, now what is going to happen here now? Now stock is overvalued because the profit component which is charged by me only. And when we prepare consolidated balance sheet, is considered as one entity only. So we have to reduce the profit and we have to reduce the stock. But By what amount? Only with the profit component and not with all the profit, only which is in the stock and goods which is sold by the holding to the subsidiary, one by one. So entry we have to pass, profit and loss account will be debited, stock reserve that we have to deduct from the stock. But who made the profit here? Understand this one. Who made the profit here, beta? Holding company sold the goods to subsidiary. So holding company made the profit here. Holding company made the profit. So working number 2 is not the holding companies. Working number 2 is the subsidiaries companies. So the holding company working note on the profit and loss is working note number 4. That's why it is working number 4. So I will debit to working number 4. I will deduct from the stock. So you can see that here. This is the point. Working note number 4. We have to debit to working number 4. Okay. We'll reduce the profit because the profit made by the holding company. So reduce the profit, reduce the value of the stock. The stock will be reduced in the balance sheet. Now, but it might be happen that here now goods here. If I change the situation that goods basically sold by a just give me a minute, by a subsidiary company to holding company then will sell it to the customer, and some might be in what here? Stock. It might be happen. So again, the value of the stock will be reduced with a profit component in that stock which is sold by the subsidiary to the holding, no doubt. But who made the profit here? Profit here made by the holding company, here subsidiary company, profit made by the subsidiary company. Now the profit, if it is made by the subsidiary company, that is not a working number 4, which is working number 2, that is analysis of profit of subsidiary company. It will go in working number 2, that's why. So who made the profit? Here profit made by the holding company, working number 4, profit made by the subsidiary company, working number 2. So simple it is, okay, working number 2 that here, okay. So but generally people ask where it will come that here. It is generally is going to come pre-acquisition only. Generally that here. The reason is that here now, generally it is going to come in the stock reserve generally is going to come. You can see that in the post-acquisition that here, not pre. The reason is that here now why it will, because we have done suppose we have done the acquisition at the starting of the year, suppose, okay. So generally it not happen that before that we purchase the goods and still it is in the stock. Okay, generally it's not happening. Suppose you have acquired the shares on 1st of January, year end on 31st of December. So obviously after 1st of January, we acquire the stock, goods and which is in the stock. It generally not happen you acquire the goods more than 1 year which is still in the stock. So generally they mention in the question when you have this transaction of purchase and sales happen pre and post period. If nothing is mentioned, so assume in the post period only. Okay. Now, one more thing is that here now is the fixed asset. What is the fixed asset sold by the same that here? Sold by the holding company to the subsidiary company. So there's a profit component in that here. So we'll reduce the fixed asset, that profit can be reduced from the fixed asset that here. And if profit made by the holding company, so working number 4, same. Now if fixed asset sold by the subsidiary to the holding company, again we'll reduce the fixed asset that, but who made the profit? Subsidiary company, because fixed asset sold by the subsidiary to holding, so it will come in the working number 2. Generally this is not so common, but still you have to remember this, okay. Now we have discussed this point here. 4th we have already discussed with you, okay. Now we are coming to the next question that here, which is the consolidated profit and loss account. So frequently they ask question on consolidated balance sheet, okay, but sometimes they may ask the question on consolidated P&L, which is very simple that here. Very simple. Let me tell you what simple that we just have to merge the figure of expense and income. Simple. This is what it is mentioned in repetition as well that here. So they say that in a preparation of consolidated profit and loss account, what we have to do, all the profit and loss account items are added one on a line by line basis. Line by line basis means that here we just have to add one by one to each of them here. Income, expense, we just add them. Okay, all the holding in a subsidiary company. Then second step, eliminate the intercompany transaction. If any intercompany like holding company sold goods to subsidiary, so it is in my sales, it is in a purchase. So we'll reduce the purchase, we'll reduce the sales that here. If there is an unrealized profit, it might be having certain goods sold by the holding company to subsidiary, a subsidiary to holding that here now. So we write it in the closing stock in P&L account. You know that. So when we write it in the closing stock in P&L account, the profit is going to be affected if there is unrealized profit in that here. That should be eliminated. That should be reduced from the closing stock. That's it. So simple. So let's take a question on it. Question number 39. What it says that here now. They say H Limited and its subsidiary S Limited provide the following information for the year ended 31st of March 2013 that year. So holding company, subsidiary company, rupees in lakh. So sales and other income 5,000, 1,000, increase in inventory, closing less opening. Generally it's happen Generally opening minus closing, but they have say closing minus opening. Okay, so understand that it should not be, it should be write it down as a negative figure. That you will say, why sir? Closing less opening, that is, yeah, it is coming positive. It means closing is more than the opening, but we don't write like this. You know the schedule 3, opening minus closing, that here. If their closing minus opening is coming positive, it means the closing is more than the opening. If we do the reverse, opening minus closing, then it will come negative figure. Okay, if it is opening minus closing. Okay. Raw material consumed 800, 200, wages and salaries 800, 150, production expense 200, and then 100 admin, no, 200, production expense how much? 200 to 100, okay. Administrative expenses 200, 100, selling and distribution expense 250, interest 150, depreciation 150. Now that we have here, what the other information. Now H Limited sold goods to S Limited of rupees 120 lakh at cost plus 20%. Inventory of S Limited includes, okay, such goods valued at rupees 24 lakh. Okay, now I will discuss, this is some unrealized profit component that I will discuss with you later on this highlighted point. The administrative expenses of S Limited include rupees 5 lakh paid to H Limited as consultancy fees. Selling and distribution expense of H Limited include rupees 10 lakh paid to S Limited as commission. So basically it's a mutual debt. So for one it is expense, for other it is income. We just have to deduct from income and expense, that's it. Now this the H Limited holds 80% of equity share of capital of rupees 1000 lakhs in S Limited prior to 2021-22. H Limited took credit to its profit and loss account the proportion amount of dividend declared and paid by the S Limited for the year 21-22. I will come to that. Now very simple, just first we have to merge it. So how much income that we have here? 5,000 and 1,000. So here you can see that in notes to account number. First they have prepared the same way like we prepare in schedule 3, that here. Revenue from operation, other income, then cost of capital consumed, change in inventory, employee benefit expense, finance cost, depreciation, other expense, same. Now, how much they have sales and other income 5,000 and 1,000. So you can see that 5,000 and 1,000 total is 6,000. There's some intercompany transaction that we have to eliminate. Change in inventory opening minus closing, that is a minus I'm just negative 1,000 and 200. So you can see that here now 1,000. Just give me a minute that here. Yes, change notes to account number 3 that they have prepared. Okay, that is 1,000 and the 200, but it should be written down as a negative figure. Okay. Here this positive, okay, they have written correctly that, okay. So it's 1,000 and 200 that here, okay. Then we have here is raw material consumed 800 and 200. You can see that cost of material consumed 800 and 200, 1,000 here. Then we have here wages and salary 800, 150, employee benefit expenses that here it will come here 800 and 150. Then we have here is production expense 200 and 100 that here. The production expenses which is coming that here now. If you see that here, okay, that will come here. Okay, production expenses is how much is the amount that is 201. That is the production is related to the consumed raw material consumed that day. That's for direct expenses. Basically, that's why they are considered cost of material, the consumed part that here. Okay, 200 and 100. Then we have here administrative expense 200 and 100 that here. So it will come in other expenses 200 and 100 that here. Okay. Then they have here selling and distribution expense 250 that here. You can write it on selling and distribution expense how much here, 250 here. Okay. Then they have here interest finance cost that is 150. So it will come in finance cost that is okay 100 and here 50 that here. Then they have a depreciation 150. So you can see that here in depreciation that they have here how much is 150 here. Okay. Now what is going to happen now one by one? So each holding company sold goods of rupees 120 lakhs at cost plus 20%. Okay, but sold by the holding to subsidiary. So it's a mutual debt. What the point that I've highlighted, I will discuss at the end that year. The goods sold by the holding company to subsidiary. It's a mutual debt there. So we will deduct from the sales. Think from the P&L account. It purchase for one company is sale, for other company is purchase. The 120 will be deducted from sales and purchase. You can see that here now. From the sales we have deducted 120 and from the purchase we have deducted here 120. Okay. Then I will come to this highlighted point. Administrative expense of S Limited include rupees 5 lakh paid to H Limited's consultancy fees. So one paid to another. So for one it is expense, for other is income. So from income we will deduct these 5. From expense we will deduct this administrative expense, this 5 here. Okay. Basically it is not 200 plus 100. This basically I'm going to say that by mistake that they have here shown as a total here, but it is 200 plus 100 minus 5, 295 that is. Okay. Then they have here is the selling and distribution expense of H limit include rupees 10 lakh paid to S limited as commission. So again, it's a mutual lip. 10 will deduct from here 10 from this income, and here will deduct the 10. Here it will come 240. Simple. Now one thing is that now they say out of this 120, 24 is still in the stock. So when I say 24, if it's still in the stock, it's a unrealized profit because still in the stock there, which is sold by the holding to subsidiary cost plus 20%. This is 20, this is 120, so how much will be 20? Yes, so 24 it is, if it is 24, 120, how much is 20? That is coming 4. It's an unrealized profit. Okay, so that should be removed from the closing stock. That should be removed from the closing stock, that is, so that they have removed from the closing stock. That is how much? 4 that is. So in outer column it is claiming how much? 1196. So write down 1196 as the negative figure because that 1196, because they have mentioned that here now closing minus the opening. Please don't get confused here, because closing minus opening that here. So that's why it's positive, because if I write opening minus closing, then it will be 1000 and it will be 200. So in that way, if I write it on in that way, I will write it on here 1000. I will write it at 200. If it's opening minus closing. Okay, if I reduce the closing, so here it is going to be positive in that case. So in that case, I will write it on here 4. Then outer column it will come 1196 like that. Okay, because this 4 we are reducing from the closing, and if this is opening minus closing, it means my opening is more than the closing. So it is coming, sorry, opening minus closing, that is my closing is more than the opening. If I'm reducing this closing that here now, so this negative figure will go down that here. Okay, don't get confused. 1200 is a negative here. You can write it like this, and you can write it down like this also. Okay, done. Now 1196 that is. So 1196. Okay, then done all this one. Okay, one more thing is that they mentioned about the holding company holds 80% shares in equity share subsidiary company. Share or 80% equity share capital offer is 1000 lakh since S limited, which is prior to 21-22. Okay, this is the P&L account we are preparing 31st March 2013. Okay, then this is H limited to credit to its P&L account the proportionate amount of dividend declared and paid what for the year 21 and 22. So we are preparing for 34 for the year 21-22. They say that they have credited to P&L account that here. Okay, so how much is the amount that they say they are holding the share capital here? Remember that we don't do the adjustment of this dividend here in P&L account because the subsidiary company not showed it as an expenses that year. They do the, whenever we give the dividend that we show, where we show the dividend that year, that we show here in which the retained earning part that year. Okay, so they do the adjustment as per schedule 3 also. When they give the dividend, they adjust in retained earning that year. So we cannot eliminate because one company is not showing as an expense in P&L account, so no need to do the elimination here. Okay, so we have done all the parts here. Yes, what we have to do, we just have to do the total here. Simple. Okay, so here if you do the note stock on number 1, that is coming 5865 5865. Then here 880. What happened? 880 and 300. Okay, 1180 1180 1196 we have written. 950, then 150 150 950 150 150. Then we have 295 and 245 35. This is the total expense. This is the total profit that they have here. Income minus expense, that is the total profit before tax. Simple it is. Okay, now understand this point that here now we have in the last part is that here is the concept of the uniform accounting policy. Now listen me carefully. What is this uniform accounting policy? It means that we are not preparing any consolidated balance sheet that year. Are we preparing any consolidated balance sheet? No, we are not preparing any consolidated balance sheet that year. What we are doing that here now is basically both the companies, whatever accounting policy they want to follow, they can do that. There is nothing wrong in that. But when we prepare a consolidated balance sheet, the accounting policy of both the companies should be same. Let me tell you the logic. Suppose I am holding company in a subsidiary company. I am following for inventory weighted average method, or you are following suppose that a FIFO method. It's okay in our individual financial statement. But when we prepare consolidated balance sheet, what happen? So the policy should be same because we have to merge the inventory. Some inventory is on weighted, some inventory is on FIFO, which is not correct. So when we prepare consolidated balance sheet, our policies should be same. So here in question 40 we'll discuss is the concept of uniform accounting policy. So what happened in case of a uniform accounting policy is that here now We're not going to prepare a consolidated balance sheet, but they give you the balance sheet of one company, that is a subsidiary company, and they will tell you that here the accounting policy followed by the holding company and subsidiary company in some cases is different that here. But if they follow, so it is not allowed to do that here. So for the purpose of, I mean, they can do that on individual financial statement, but when it's come to the consolidated balance sheet, they say it is not allowed to do that here. So we have to restate the balance sheet of subsidiary company in such a manner that the accounting policy of both the companies what same. Now let me tell you that what is going to happen in question number 40. We will prepare a restate the balance sheet, not consolidated balance sheet. So basically the accounting policy which is followed by the subsidiary company, some accounting policy differ from the holding company's policy. So we'll do the adjustment in subsidiaries company's book. So the policy of both the companies should be uniform, should be same that year. So always prefer to go for the double entry system. So what happened that now? I will read the question. They mention us that here where the accounting policy is not the same, and I will explain in that here. I've already written that here. You can pause the video and you can write it down. But these I will share in that, and these the Telegram channel. These the analysis that I have done that here. Okay, I will share there. Okay. Now here. So I will read that question and how basically when you uniform the accounting policy, we have to do the adjustment entry. Now it is going to affect the item in balance sheet, and always the second effect will come in the profit that day, because when you make the policy uniform, you're doing the adjustment in the profit and the other relevant point. For example, you're making the policy of trade receivable uniform. So one effect will come in trade receivable, one effect will come in profit. If you're doing the here the uniform policy inventory, one effect will come inventory, one effect will come in profit in reserve and surplus. Okay, I will explain it. Don't worry for that. So now let's come to question number 40. They say that they consider the following summarized balance sheet of subsidiary. So they have given us the balance sheet of the subsidiary company M&T Limited. So 2 years figure is given 22-23 and 23-24. Share capital issued and subscribed 7,000 equity shares of rupees 100 each, 7,50,000, 7,50,000. Then they have given is the reserve and surplus that here now. Revenue reserve 2,14,000, 5,05,000, securities premium 72,000, 2,07,000. Then current liability and provision that here now. Trade payable 2,90,000, 2,46,000, bank overdraft dash 1,70,000. Provision for tax 2,62,000, 4,30,000. Then we have here is asset, fixed asset that here now is that is the cost 9,20,000 and here 9,20,000, accumulated depreciation 1,70,000, 2,82,000, 500. Okay. Now here is the investment at cost dash 5,30,000, current asset in current asset that they have here. Inventory 4,12,300, 6,90,000, trade receivable 2,95,000, 3,43,000, prepaid expense 78,000, 65,000, cash at banks 52,700, 42,500. That okay. Now other info. This is a balance sheet not of holding and subsidiary, on the subsidiary. They say other information M&T Limited subsidiary of LTC. Okay, so holding company is a LTC and M&T is a subsidiary company. Now they have given the 3 adjustment that here. Okay. Now I have already written the accounting entry here, and they ask you, I will explain you all these 3 adjustments. They ask you that here, restate the balance sheet. They ask you to restate the balance sheet of M&T Limited that year as on 31st March 2024 after considering the above information for the purpose of consolidation. Such restatement is necessary to make the accounting policy adopted by the holding company, that is LTC Limited and M&T Limited uniform. Okay, so we have to do the changes in the books of account of subsidiary company so that the accounting policy of both the companies should be uniform. Okay, now we will discuss each of them, but remember the one effect in profit, one effect in the relevant item. They say LTC subsidiary company. LTC Limited values inventory on FIFO basis, while M&T Limited use LIFO basis. So basically LIFO is not allowed as per schedule, as per AS2, but okay, we cannot argue with IC at it. Okay, so they say here's a subsidiary, here the holding company for a FIFO and subsidiary company for a LIFO. To bring the M&T Limited inventory value in line with those of LTC, its value. Okay, M&T is a subsidiary, so it's a holding company. Let me write it down. Holding, this is subsidiary. Okay, now here is to bring the M&T that here limited inventory value in line with the LTC. Its value of inventory is required to be reduced by 5,000 at the end of the should be reduced by rupees 5 at the end of 20 to 23. It's mean opening stock. They're saying opening stock should be reduced by 5,000, and increased by rupees 12,000 at the end of the 23-24. It means the closing opening stock should be reduced by 5,000 and this the closing stock should be increased by the 12,000. But they say inventory of 22-23 in last year's stock has been sold during the year 23-24. The opening stock already sold. So no need to the adjustment, that goods already sold. Okay. But the closing stock that they have 12,000, they want to increase it, they want to increase it by 12,000. So again, now you have to pass the entry, you have to write it down there. As stock is asset, increase in asset should be debited. So stock account will be debited by 12,000. Increase in asset, we are going to increase the stock by 12,000. Stock will be debited by 12,000 and profit will be increased by, second effect will come in reserve. Stock account debit to reserve account. So what happened is that now, two effects, stock account debit to reserve account. So what happened that when they prepare the balance sheet that here in just all the same fashion they have prepared all these notes to account. So what happened, I will explain each of them. So what happened that they've increased the stock, whether they have increased the stock by this 12,000. Second effect, they increase the profit by 12,000. They increase the profit by 12,000. Okay. Then here they say here M&T Limited deduct 2% from trade receivable. Means subsidiary company deduct the 2% from trade receivable as a general provision against the doubtful debt. It means subsidiary company is deducting the 2% from trade receivable, but holding company is not doing that. So we should also not do that for the purpose of holding. So, but how much is the trade receivable we have? The trade receivable that we have, that is coming 3,43,000. 3,43,000. But understand that now. I say that here now 100 is the trade receivable. I deduct 2% that here, okay, 2% that here. Now it is coming 98%. You know how much is mentioned in the balance sheet after deduction? They've already, M&T Limited deduct the 2% from the trade receivable. The value which is appearing here, 3,43,000, which is how much in 98%. So we should not, we should not deduct when we talk about the uniform accounting policy. So we have to increase the value. So if I say 3,43,000 is 98, how much is 2? So it will come here 7,000 here. So we have to increase the value by 7,000. So it will come at 100%. So when you deduct from the trade receivable beta, so what entry we pass? P&L account debit to provision. That provision will be deducted from the trade receivable. Now reverse the entry. If I say P&L to trade receivable, reverse the entry, trade receivable to P&L. So trade receivable will be increased by 7,000. I have done the calculation at 3,43,000. If it is 98, how much will be the 2? This 2. If 3,43,000 is 98, how much will be the 2? So here, if I pass the entry to deduct from the trade receivable, I have to add to the trade receivable. I will add to the trade receivable as 7 and we credit, we are going to increase the profit by 7. So what I will do that here now, we have to pass the entry, trade receivable account will be debited, reserve account will be credited. So you will see that here now, trade receivable, they have to increase by 7,000. Where they have written this trade receivable? Okay, they have written here. Okay, no problem. And it is 3,43,000 plus 7,000. That is 3,51,000 effect that they have given here, and profit that they have increased by 7,000. Okay. Then here, third point here. Okay, then they say, this is interesting. Let me read it and I'll explain. I have written each and everything here. They say here prepaid expenses in M&T Limited include sales promotion expenses carried forward of rupees 25,000 22-23 and rupees 12,500 in 23-24 being part of the initial sales promotion expenditure of 37,500 in 22-23, which is being written off over 3 years. Similar nature of sales promotion expenditure of LTC has been written off in 22-23 only. First of all, this is a key word. They use the word carried forward. Now listen carefully. What happened in 22-23 that year? They incurred some sales promotion expenses. They incurred some sales promotion expenses that year. Okay, they incurred some sales promotion expenses. Now listen carefully. What happened? What M&T is a subsidiary company. So they are writing off over a period of 3 years. So total expense was 37,500. So if I say type in calci 37,500 is the total sales promotion expense. They're writing off over a period of 3 years. So divided by 3, every year 12,500. So 37,500 was the balance at the starting. So they basically that every year they're writing off 12,500. So 12,500 they write it off. So basically that they mentioned that in the question that year. The 25,000 was the balance there. Okay, 25,000 was the balance there. So this 25,000 was the balance, carry forward balance that is. So the 37,500 was the total expenditure. They carry forward 25, it means they write it off 12,500. The next year that they have a balance of 12,500. So here from now this 25,000 carry forward here. Again that they have balance of 12,500. So they write it off this much. To make it simple, every year they are writing off in 3 years. So 37,500 divided by 3, every year they're writing off 12,500, 12,500. But only 2 years happened, 22, 23, 23, 24, 24, 25 not yet come. But the same amount of expenditure, write it off by the LTC in the first year only. So they have, the one company have written off in 2 years, 12,500, 12,500. Still the third year not yet come. That's why that 12,500 of the third year is not yet write it off. But the LTC write it off the same in the 1 year only. So LTC have written off the same expenditure 37,500 in the 1 year only. They just have to write it for 2 years. Not yet they have come to the third year. They have write it off 12,500, 12,500. They have write it off 25,000. One company similar expenditure they have write it off 37,500. Another company write it off the 25 only. This 12,000, if you do the balancing here, 37,500 minus 25, this 12,500 balance to be written off. So when I will write it off this, the prepaid expense that here now, I will write it off that here. P&L account will be debited and prepaid expenses will be credited. So when I say that I will write it off, profit will be reduced here. So we have to pass the entry, reserve will be debited and prepaid expense will be debited here. Profit will be reduced. So you can see that here now we reduce the profit here. We reduce the profit here by 12,500. Okay, we reduce the profit by 12,500, and here the prepaid expenses that they have, the balance which is appearing in balance sheet is here 65,000. They deducted 12,500 from this. So we pass the entry, profit reduced by 12,500, and here also that we reduce the balance of the prepaid expense by 12,500 because we pass the entry, P&L account or reserve account debit to prepaid expense. That's it. Not just we have to write it in the figure from the balance sheet. We are preparing. We are in 23, 24. The issued capital is 7,50,000, no change in that. So you'll see that is 7,50,000. Then reserve and surplus 5,05,000. So 5,05,000 they have titled on a working note. We have done this adjustment, and this is the figure 5,11,500. So 5,11,500 we'll write it down here because this securities premium also. Then here they have a securities premium 2,07,000. Here they have write it down in note stock on number 2,07,000. Total is 7,18,500, 7,18,500. Then they have, we are not preparing consolidated balance sheet. Okay, don't do the merge here. Okay, we have done the changes in the books of the subsidiary company to make the uniform accounting policy. Trade payable 2,46. Trade payable 2,46. Okay, it's in short term. Okay, this bank overdraft is short term borrowing 1,70,000. Okay, provision for tax 4,00,000. Just copy paste. Okay, this is 637,500 non-current investment 5,30,000, 5,30,000. Inventory 6,90,000. So inventory is 6,90,000 that here now, but why is 12,000? Yeah, we pass the entry stock account debited to reserve, so stock should be increased by 12,000. Okay, this 7,02,000. Then we have here trade receivable 3,43,000, and 7,000 of that adjustment 3,15,000 outer column. Prepaid expense 65. You can see that 65. We deduct this 12,500 in outer column, that is coming 52,500. 52,500. Okay. Then the last they have cash at bank 42,500. 42,500. That's it. Okay. This question might come for the 10 marks that here. So we have not prepared consolidated balance sheet. We have prepared what here? We have prepared here. We change the figures in the subsidiaries company's financial statement to make it uniform accounting policy with the holding company. So always go to the double entry system. Always go to the double entry system that here. So pass the journal entry, see what effect is going to come here. One effect is on the profit, another effect is on what? The relevant item that here. So this is all about the consolidated financial statement. Now I will share these PDF as well that here. Okay, analysis part in the Telegram channel. I will share obviously after this recording. I will share the link as well that there. Okay, or when I will upload this lecture on YouTube, I will share the link. I will share these also there. Okay. Now one more thing is that here now is you have to do the practice of these questions that here. Okay, you have to do the practice of this question. It will help you, but follow the same process that I mentioned. This process is very important, that the way I solve the question that here. Okay, you exactly like that you have to do that here. Okay, so it otherwise this chapter people find it very difficult if they don't follow this the flow. This flow is very important that here. Okay, so now we'll conclude here. If you want to say anything to me, you can write down in comment section that day. Okay, that is for today. Take care, all of you. Bye bye.